So just imagine that. You click a button and $29,000 comes out. Click a button and $29,000 comes out. That's what she did on one trade. In this video, we're going to review her breakdown and we're going to dig into what made this trade so effective. Now, if you are looking for inspiration for your trading strategy, this video is going to help you. And even if you're not, and you just want to sharpen your skills, this video is going to help you too. So let's see what we can learn here. This is Tori Trades.
All in all, this was a record trade at the time. It was $30,000. So my entry, I got in at $888. So we're looking at around here when the price broke this steepest downward trend line. I went in 20 contracts. I was willing to risk $15,000 if this trade does not work out.
Okay, so already we know something about her strategy. Now she's risking much less than she's looking to make. So the risk on this trade was $15,715. $15,715 to make how much? $29,000. So what that tells you is that her risk to reward ratio is excellent. Now, bare minimum, you want at least a 1-to-1 risk to reward ratio, but this is significantly more, almost 2. So already you can tell that she knows what she's doing in terms of managing her risk, because that's how you structure a profitable trade.
If this trade does not work out.
Now, before we get into the trade breakdown, I want to show you a 60-second video breaking down her strategy in 60 seconds so that when we get into the breakdown, you'll have an idea and be able to understand what she's talking about.
What is my strategy? I truly just trade with trend lines and some support and resistance. I always use trend lines. I'm going to come in with 1 touch point, 2 touch points here. And this is platinum. This is a great example. We've got 1, 2, 3, almost 4 touch points here on this upward trend line. I would get into this position only because the trend line was broken. So we'll just say, for example purposes, we've got 1, 2, 3 touch points on this downward trend line, and then boom, we've got a break of a trend. I would take a long position here. Now we are following up. We're going up, 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 up. I would stay in this position for as long as the trend is happening. And my indication for when it is no longer trending in that direction is when price breaks that trend. That is essentially my strategy in a nutshell.
Okay, so we know that she's using a basic trend following strategy, which is drawing trend lines, waiting for an indicator to enter, and then following that trend to maximize her profits. All right, good. So now we got that. Let's get back into it.
Trendline trades. Today we're going to be going over a 3 touch point break. We're going to go over the playbook, my criteria for entry, my entry itself, my exit, where my trend lines were, where my key levels were, my horizontal lines, support and resistance. And before we do, I always make sure I want to start with, I say always, this is literally the second video, but I want to start this video with showing you guys my brokerage statement for the trade that I placed, just to make sure that you guys can see the validity, my credentials. I am verified. And
okay, so this is why I like Tori Trades, because a lot of people criticize Tori and say that she's fake, but she's about to show you her broker statements, okay, which is irrefutable evidence that what she's showing you actually happened and that she's legit. So let's see it.
We'll get into it. So let's start with my TradeStation statement for February. I'm going to start by logging into the Client Center of TradeStation. There we go. All right, here you can see this is the
okay, so I want to give a shout out to Gilbert in the chat. He said Tori Trades is fake. Hey, Gilbert, let's have a look at this right here, okay? Let's see how fake she is.
Statement of February 29th, 2024. You can see my account number, and here we go. We have the beginning balance is $123,000. The net futures profit and loss is $29,785. And then you will see there is actually an open trade in the negative $4,000 as the statement closed. So that is unrealized, but the realized profit and loss for the month of February is $29,785. This is the one trade that I did place in February, and this is the one we are going to go over. All right, so
there you go.
So we're going to start by going into my TradeZella. This is where I can journal.
And by the way, very, very few traders will show you verified broker statements like that, okay? So for anybody who's skeptical, there you have it.
Everything. This is where I can dissect everything. I can go back through and recreate my trend lines. I can see how many contracts I traded, how many points, how many ticks, my commissions, my net ROI. I can see how much I was down, how much I was up. I rate my trade. I gave myself 4 stars on this trade. You can see my risk on this trade. You can see my R multiples. It was 1.9.
And again, risking 15,700 to make 29,000. Very good risk to reward.
And then the coolest part is you can tag your setups, you can tag your mistakes. You can also see all of the notes that I gave myself for this trade and the running profit and loss. How much?
This is something you see with traders who are really good. They keep very meticulous notes and they're journaling their trades. They're winning trades and they're losing trades. You can see all the notes that she's taking. She's paying very close attention. It's not just like some set it and forget it. She's thinking about every single detail and going over it with the fine-tooth comb.
I was down, how much I was up. So we're going to start by going through the notes so that I can also remind myself what was going on, what was happening here, what was the mindset. And then I also have a playbook that I want to run you guys through as well. When you add a playbook to your TradeZella, you just get to check off, first of all, the satisfaction you get from checking off a box. When I tell you, that is so satisfying. And then seeing this, 2 out of 5 checklist did everything align. It's the coolest. But you'll
a sign of discipline. This is a sign of a disciplined trader. Do you have a checklist? And when you're trading, do you have the discipline to follow that checklist? That's something I do, and that's something she does. And that's something you see traders do that have discipline that are effective, because they know that to be consistent, you have to execute consistently, and your mind is all over the place often. And so having documented, clearly articulated rules with a checklist to go through procedurally, just like a pilot. You ever seen a pilot just going off the checklist before they take flight? It is the difference between life and death.
You'll see the playbook that I have here. This is a 3 touch point break playbook. And then these are all of my entry criteria, my exit criteria, and market conditions. And then we will check these off as we go through it. Okay, so first let's go through my notes just so that I can refresh myself on what we're going to go over. So this is the second trade of the year. This is my true 3 touch point breakout trade. Overview, I'm giving myself 4 stars on this trade, largely due to the breakout of a 3 touch point trend line. While the trend line did not have as much data behind it as I would have liked, only a week's worth of data, it still met the criteria. When I say that it doesn't have that much data behind it, it just means that I don't have that many candles, that many bars, that many days behind this trend line. So I did get 3 touch points, but those 3 touch points were all within a week. I usually like to see weeks worth of data. I mean, if not more, months worth of data. The touch points that you get on a trend line over the span of a month, a few weeks, a few months, it holds so much more weight than just simply a week's worth of data with the 3 touch points. So I still checked off my criteria, but it just didn't have as much data behind it. The setup details. This was trend line break.
Okay, so one point on that. A lot of times traders are looking for the perfect setup, right? The perfect setup for the stars to align in just the most perfect way for them to take the trade. There's a perfect setup and that things will align perfectly for them, which is usually not the case. In fact, almost never. Every once in a great while, you will get a perfect setup. Now notice, this trade was a banger, man. She closed $29,000 on this trade, and she's saying it was imperfect. So that shows you that your ability to actually adjust instead of waiting for things to be absolutely perfect is key here. You have to know what good enough looks like, and she knows that, and this is evidence.
I entered on a trendline break with 3 touch points, despite the limited historical data. Position size, I came in heavy. With this position. I turned it actually into a higher risk trade. So I could have made this a low risk trade by simply reducing my position size, but instead I actually did the opposite. I came in heavier. This was my record trade at the time. When I closed, the most I have ever made in a singular trade before.
Okay, so just imagine that. You click a button and $29,000 comes out. Click a button and $29,000 comes out. That's what she did.
$29,871. It was very close to $30,000. And to be honest, I probably thought I made $30,000 and I probably closed it when it said $30,000, but the difference between spread and commissions brought me down to $29,871. Okay, let's go over where I entered this trade. a few downward trend lines here. We've got this higher time frame trend line starting all the way back from the very end of 2023, then coming in with a second touch point here at the end of January, very end of January, January 31st. So 2 nice touch points here. And then I decided to come in steeper, track price steeper and steeper. So we've got yet another steeper trend line here. This is the 3 touch point trade. So I'm going to zoom in now so you guys can see where these higher time frame trend lines come in. But now let's zoom in and get a closer look at this trade. So when I decided to come in steeper, this trend line here, when I am coming in steeper with my trend lines, I always want to use previous touch points so that it looks like this fan. It looks like a fan of downward or a fan of upward trend lines. So I'm always using previous touch points to continue to track price steeper and steeper. So when we...
I like that, because what you can see if you do that is you can see how the trend is changing with time, right? You can see, is it getting stronger or is it getting weaker, which is smart.
Came in with this steepest trend line. This was the 1, 2, 3 touch point trade. Almost 4 touch points, but not quite here. So we've got 3 touch points on this downward trend line. We've got the entry based on the break here. So my entry, I got in at 888. So we're looking at around here when the price broke this steepest downward trend line. So far, we can go down and check off our setup. 1, we did have a trend line break. 2, this trend line did have 3 touch points. But now 3, this was a high risk trade. When I get into a trade and I am calculating my risk, the risk trails. It always trails along the opposing trend line. But my initial risk is if I get into a trade and the price immediately goes against me, that's going to be my initial risk. But the risk will always trail. It continues as price progresses and continues in my favor. The risk becomes smaller and smaller and smaller.
Okay, so she's just talking about a trailing stop, which is one of the best strategies a trader can utilize, because what it says is as the market moves your way, you continue to reduce your risk and increase your ability to capture more profit, which is awesome.
Smaller. Eventually, risk will be in profit if price does continue to trend.
Exactly.
In your favor. But the initial risk is what I'm always going to be showing you guys. So if I get into a trade, immediately it goes against me. This is the amount I'm willing to risk on the trade. So first things first, we entered at 8.
Okay, pop quiz for everybody watching this right now. Do you predefine your risk before you enter a trade? Do you always predefine your risk before entering a trade? Yes or no? It's a yes or no. This is the difference between the amateur and the professional. One of the biggest differences. There are many. One of them.
88. I went in 20 contracts. I was willing to risk $15,000 if this trade does not work out. Now, before I start, I do want to go through my initial balance so that I can see the percentage. My beginning balance when I got into this trade was $123,000. So, Alexa, what percentage is $15,000 of $123,000? $15,000 is 12.2% of 100. Dude, I've been heavy on the risk. Both of these trades are very risky. Came in real heavy. Now, if you guys saw my previous video where I broke down my first trade of the year in platinum, I made $10,000. There was an area or an opportunity to cut my risk in half, and I was presented with yet another opportunity to cut my risk in half. I did not. So this year, I am trading bigger position sizes, and I'm willing to give up more to see this thing through, my boy, if you get what I'm saying. I could have mitigated my risk more in this trade initially. So let's try to break it down. I'm going to try to make sense of this. It's not going to flow beautifully, but I just want to show you guys what I could have done a little bit better, what I did instead, and what happened during this day. So,
okay, pause. She made $29,000 on a trade, and she's thinking about what she could have done better. Do you have that level of dedication and commitment to excellence? You make $29,000 on a trade and you're still looking at what you could have done better. That is a level of commitment to excellence that is very unusual. And that is what this takes. So I want to point that out because that is what this takes. Trading consistently well takes that kind of commitment where even when you crush it, and you make twice as much as you risk, which is a banger trade, and you put $29,000 in the bank, you're still like, hey, what could I have done better? I'm still not satisfied.
So the entry here, now it says that it's a day later, but I entered at 8, and this bar didn't even make it to 888. So I'm almost certain I entered at this bar here. This may be also because I had bid adjustment toggled on. I've been experimenting with the bid adjustment. If you guys trade on TradingView, you know there is a bid adjustment for the futures market, for futures charts that you can toggle on and off. And it simply just helps with when contracts change from one to the other after it expires. It helps with the gaps, and it helps create this easier flow of price instead of so many gaps. And when I'm trying to track price with trend lines, the least amount of gaps I get, the better. So I'm still experimenting with that. If you guys have any advice or have any insight on the bid adjustment, the pros and cons, I'd be fascinated to hear it, because I'm still experimenting with it to see if it helps or hurts my trading. But so far, it's been mostly positives. So we've got the entry of the 3 touch point break. How could I have risked less in this trade? My initial risk was $15,000. How could I have cut that in half? Well, let me show you. So speaking of capital, your digital footprint is capital. And the amount of scammers and spammers out there, they are truly trying to steal your capital. And if you guys know me, which some of you guys do, if you know, you know, my number one come up here using another touch point here. So I could have came in with this last low, this pullback here, and then my risk only would have been, let's see, it would have been around 879.30. So if my trade wouldn't have worked out, my stop loss would have been around 880, we'll say 880.40. I would have been able to only risk $8,000 for this trade. That would have been best case scenario, but that would have also been a loss. So if I would have gotten in because of the break, I would have also been stopped out. That $8,000 would have been hit. I would have closed this with a loss. So there was a benefit to risking more because it kept me in this trade.
Okay, so that's a really key point. So we can see here that she entered here, okay? And let's just zoom in on what she's saying, just in case you guys aren't following. So she's entering here, right? And then she's saying that she could have risked less. She could have put her stop loss right here at this support area, right? But she didn't. She chose to put her stop loss at this support area. Notice she said she draws these lines, and the line is where she trails her stop. So that means her stop would have been down here. So she's pointing out that she could have reduced her risk by half. So if her stop loss was here, she would have been risking half as much. So instead of $15,000, something like 8,000. However, she would have lost. She would have lost that $8,000 and she would have been stopped out. So the take home point here is that if you use tight stops, usually you will get stopped out more often. And in this case, her being willing to risk twice as much was the difference. Now listen, was the difference between losing 8,000 and making 30,000. Think about that for a second.
It ended up pulling back. Now, why did I stay in this trade? So let me kind of go over where my initial risk should have been, where it would have been, and where it technically was, and why I ended up holding and risking more and using my original trend line to mitigate my risk instead of this steeper trend line. So when the price came down, you see this giant red bar here. We had a news day, price moved pretty quick, pretty far, and crossed within the day, to be honest, within a few minutes. And I was willing to go ahead and let it come all the way to and break my original line, which I'm going to scoot over here so you guys can see a little bit better, my original upward trend line in order to take this loss or solidify this loss. So now I'm going to change this trade risk to this original upward trend line, ever so slightly up. It almost looks horizontal, but this is an upward trend line that's drawn from a higher time frame. But we created a third touch point here. When I tell you I was sweating on this news day, I was sweating on this news day.
Yeah, I bet.
The price came down and literally kissed my upward trend line, created yet another touch point on this upward trend line. My stop was on the other side. If the price was to get to this 873-ish area, give or take a few cents, I was going to be willing to solidify that loss. It would have been around $15,000, 15.7 to be honest. So this steeper upward trend line, I said, delete. I'm going to let this higher time frame line mitigate my risk and dictate my exit. So
I want to make a point about the mental game of trading, because a lot of traders only talk about the technical game of trading, but they don't talk about the mental game of trading, which is managing your mind and emotions while you're executing your trades. And the amount of discipline and presence, inner calm that anyone would have to watch a trade go in profit. Now notice she entered here. So she entered, and shortly after she entered, the price went in profit. But then look at this huge red candle down. Okay. So shortly after entering, she goes in profit, and then immediately the price plunges downward, and her P&L is close to $15,000 negative. And what she was able to do was stay cool as a cucumber, baby, cooler than a polar bear's toenails, and just chill. And then what happened? The price went within probably a few $100s of her stop loss, almost losing $15,700. And she's just like, you know what? I'm happy to lose $15,000. That's what I said I was going to lose. And I predefined my risk before I entered the trade. And I knew that's what I was willing to risk. And I was willing to risk that. And so I'm willing to risk that, because that's how you execute a strategy properly, is you respect your rules. However, she didn't panic. And then the trade went her way. And I just want to make a point about how much discipline and patience a person has to have in order to be able to pull that off. It's a lot.
So I held. Okay, so price created another touch point on this upward trend line, and then immediately the days to come, the days after, sense of relief. We got an upward bar, we got a green bar, we got another green bar.
And then immediately that whole move, look at this, that whole move, right? That sent her P&L plunging down negative 15 grand. Right after that, plunges up, races up, and then retraces that whole move down. So that's how it is when you're trading, man. That's exactly what things are like. And that's a good example of the kind of turbulence that you have to be ready for. You know, like on an airplane when you hit turbulence? Yeah, it's like that. But imagine that with your money flying all over the place.
We are continuing to break these steeper downward trend lines. We got a sense of relief after every upward bar, after every green bar was coming back in our favor. So we're getting out of drawdown. Bar after bar after bar. Price is continuing up now. Now let's go over the exit. I closed.
Okay, so she enters here, right? So far, let's just trace this back. She enters here. Price goes slightly in her favor. Plunges down, almost stops her out, probably comes within a couple $100s of stopping her out, and then immediately makes a double bottom here, right? One bottom here, second bottom here, and then rips up, okay? And then you get one small pullback here, you get another move up, you get another slightly bigger pullback here, and you just have this kind of nice gradual upward movement channeling up, and she exits right up here, okay? Near these prior lows. So let's see how she explains, why she exited there.
Here's my trade at 918.62, this horizontal level here. Now let's zoom out and see how many touch points this has. So the likelihood of platinum to touch this key level, to touch this area of either support or resistance, depending on which side the price hits it on. The likelihood of the price of platinum getting to this level and then turning around was fairly high. So we've got a touch point here. I'd say we've got a touch point here. Now close enough over here, price hung out around this level.
So key point, when you're in an uptrend, as she is here, prior lows are resistance areas, which are reasonable areas to take profit. So right here would be one, 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 right here would be one. So any of those prior lows is a reasonable place to take profits.
Price touched it again here. So we've got a few solid touch points and then a few.
And one more point on that. If you have an area where there's a lot of prior lows, right, where there's a cluster of them, that's even more reason to take profits there, because then you have agreement that traders see that as an area of resistance.
Few areas where price just really hung out around this area, and especially over here. So the price got to this level.
And that's what you've got here, right? So you got prior low here, prior low here, prior low here, prior low here, right? So that's why she drew that line there. And also, this is what she's saying. This is why she took profits there.
And then did.
And look at the trade. This is extraordinary, okay? Look at the trade. That was such a key area that as soon as it hit that area, look at what happened afterwards. It went down. So she sold almost perfectly at the high, which is incredible.
truly what it was supposed to do, bounced off, rolled off, rejected it. Now it did pop through it, and I'm sure a lot of people thought, oh, this is it, we're going. My entries are not based on these horizontal levels, simply my exits are. Now I do use these horizontal levels as confidence, as confirmation for my entries, but I do not use these solely for my entries. Exits, yes, all day, love it. Best case scenario, I am exiting because of a break of a trend, but if I am exhausted, I'm done with my trade, and I'm looking for an area to close it as soon as possible, an area of support and resistance or these key levels is going to be next best scenario. So I closed my trade simply because it got to this level here. Okay, so let's go over the executions here. I entered my trade on February 12th, and then I closed my trade on February 20th. This was a net profit and loss of $29,000, $30,000.
And just want to give a shout out to Liz Wee in the chat. And Liz Wee, I wouldn't say that she's gifted. I would say that she's practiced, okay? She used to be a hairdresser. This is not God-given gifts. This is developed. This is talent that she earned through hard work, dedication, perseverance. She's been at this, I think, 8 or 9 years, okay? This is something that you develop. Talent is something that you earn and you get with hard work. It's not like a gift that someone gives you.
Now,
and even if you have gifts as a trader, you have to develop them. So regardless, this is a product of hard work is really what I'm saying to you.
If you want to kind of bring this down, scale this down a little bit, if you were to be trading 10 contracts, you would have made $15,000. If you would have been trading 5 contracts, 1 contract. So you guys can kind of scale that down yourselves because I literally have math stage fright to where I can't do math when I'm recording. So, and let's be honest, I really can't do it even when I'm not recording. So I went long right here on this bar. Price is coming up, boom. Long position here. Now we're feeling good. Okay, we're going sideways. We're not going anywhere. We're feeling really good. And then boom, one big red bar. Now, if it would have broke, that would have been a loss. That would have been my $15,000 solidified loss. Price does such a sporadic, hectic move on a news day that I had the guts to hold through it. And
she had the guts to hold through that. It's just so awesome. I just love that. I love that. To me, it's inspiring. It's inspiring. For all the times that you've ever panicked out of a trade, just think about this one right here, okay, from Tory Trades, clocking 29,000.
Let this original line dictate staying in. I was willing to let price settle since that was such a big move, and it did. It made a sporadic move down, aggressive, steep, big, and then just puttered out, and then we're back to our average price action.
Made a double bottom, right? Slightly higher than the prior bottom, and then ripped up.
Boom. Normal movement, normal movement. Okay, I'm going to do one more trend line or one more example to show you guys if I would have closed based on a trend line instead of a horizontal line, instead of an area of support and resistance or a key level here, my exit would have actually been, okay, I would have used the last low here, touch point here. I would have tracked this steeper, touch point. So I could have waited until 9:05 to close my trade, which would have been 888 to 9:05. Still a good profit, but I wouldn't have been able to maximize and get the most amount of this move here. So yes, we've got an upward move. It's not the most beautiful. It's not one of these or one of these, which is what I wanted so bad. I wanted a beautiful move like this, I didn't. I got a mediocre ebb and flow, up and down, ever so slightly, not as aesthetic upward move here. I still got it. I still was able to get in on it, even though it wasn't much of a move. It wasn't the one I was expecting or the one I was wanting. And for the most part, I want to let you guys know that that truly is why I was willing to risk so much for these trades, because I wanted to catch something like this. This upward move, this downward move, but that's just not what the market gave me. The market didn't make one of those big moves, which I wanted on the previous trade that I'd went over before this one. I wanted one of those big moves, but it's just the market wasn't giving me one.
Okay, another great example of very solid mental game, okay? Mental game, again, is not how you manage your technical trades. It's how you manage your mind and emotions. And a lot of traders neglect this. And what you see here is one of the hardest things to learn in trading, which is there's something that you want and you have an idea about that, how that trade's going to go. But then the market does something different. And this is very often what happens. And the question when that happens is, can you adjust? Or are you going to try and force the market to do what you want? Because the chart is not going to do what you want. It's going to do what it wants. The chart does not give a about your thoughts, does not give a about your desires, does not give a about how much money you want to make or what you think it's going to do. Okay. It's going to do what it's going to do. And that has nothing to do with you, and nothing you do is going to affect it. It's like the ocean. Okay. It's like surfing in the ocean and trying to control the wave. You have nothing to do with what that wave is going to do. So what can you do? And what's a good surfer do? The surfer rides that wave, baby. He has an idea of what he thinks is going to happen. That's why he starts paddling out into that wave. But then once he makes contact with that wave, you have to adjust and you have to fuse. You have to merge. You have to flow with it. Okay. So you go with what you think is going to happen. But as you make contact with reality, as you enter that trade, you start to work with what shows up. And that's what she was able to do. She says she wanted a big ass move like that. A big ass move like that would have been like 5 or 10 times what she made. But instead, she was able to adjust, and not only adjust, but still close a stellar, incredible trade for $29,000 profits at a really, really good exit. Okay. So really props to Tori Trades on that for being able to adjust and work with what reality is giving you. Work with what the chart is giving you. Again, it's very hard to learn how to do that, and it takes a lot of practice. So you can see that she's able to do that, and we all have something to learn from her with this example.
So I was willing to risk a little bit more in order to be in on a move like this in case we were in one, but we just weren't. We weren't. I was up 30,000. Price got to this horizontal level, this key level here. I closed. If I wanted to stay in this for a little bit longer in hopes that maybe this was going to be a move and maybe I was willing to give up some of that 30,000, then I would have closed around this 904, 905-ish area when price broke the trend that it was trending along. But I'm going to delete these upward trend lines now since that's not what I used to close my trade. It wasn't what I used for my exit. I used this horizontal level here. So let's go over the playbook first and foremost. So I'm zooming into the trade here. I'm going to my playbook here in TradeZella.
So this is her setup. Okay. This is the criteria that she uses to decide, what her strategy is.
And these are the criteria that I gave myself for this specific playbook. This is the 3 touch point break playbook. So I got 2 out of 5 of my checklist. The trend line had 3 touch points. Love it.
Remember when I said before that traders are looking for the perfect pattern and the perfect setup? This is a 2 out of 5. A 2 out of 5? Are you kidding me? With her criteria, and she still had a banger trade. So it's really not about waiting for the perfect setup. As I said before, it's about knowing what good enough looks like.
I could have checked off this low risk setup if I hadn't come in so heavy in position size. So I came in 20 contracts versus my 10 contracts. So I wasn't able to check off this low risk setup. If I did, I would have been able to check that box. Okay, exit criteria. Was the opposing trend line crossed? No. Was a support and resistance level hit? Yes, I was able to check off that one. Okay, so market conditions. Are we in a trending market? And the answer was no. We were not. We're actually in consolidation. So I was able to capitalize on a long position on an ever so slightly upward trend. It didn't last very long. We just weren't in a trending market at the moment. This right here is an example of a trending market. Getting in on the current trend. The trade that I took was not within a trending market. It ended up going sideways for actually a week or so after I even closed the trade. So we were actually in consolidation when I placed this trade, so I didn't get to check that box off either. So in my playbook here, I was able to check off 2 of my boxes here. 1, that the trend line had 3 touch points, and 2, my exit criteria was hit the level of support and resistance. So that is my playbook here for the 3 touch point break. And then let's go down to the stats here, and we can see I labeled this a trend line break. I also labeled this a high risk setup, and I also labeled this a 3 touch point break. Not only was it a break of a trend line, but the trend line had 3 touch points and it was higher risk. I could have made this lower risk. I could have labeled it low risk if I had reduced my position size, but I didn't.
If the only thing you took away from this video, okay, if you clicked on this video and you go, oh man, someone could make $29,000 in one trade, and then you watch this video, and the only thing that you took away from this video was to establish a very clear checklist with the specific criteria that lists your rules and procedures for entering your trade, that would be worth it. Just that alone, okay? If you came onto this video and you were wondering how to close a trade for $29,000, one, and you're like, okay, I need a checklist with very clear rules, then your time here was well spent.
Now here's the mistake. I held through news. The news day created such an aggressive move, one that made me sweat and one that made me resort to a higher risk trade and a bigger loss if the trade did not work out, using a less steep upward trend line. Okay, and then here's my running profit and loss. Close that bad boy at $29,000. $29,905 was the gross, I believe. Okay, missed opportunity. I missed the short position earlier in the month, but I'm glad I was able to capitalize on this trade instead. And then the last thing is exhaustion factor. So holding trades over the span of a week and being in X amount of drawdown and then being back in profit, it's just seeing those numbers fluctuate and being in for a week, give or take a few days, more or less, could very well dictate closing early, not staying in for the entirety of the move. But I will say overall, this trade was solid and it ended with a record profit. So I'm happy with this trade. I gave it 4 stars, mostly because of the entry criteria, the exit criteria. I'd say the downsides to this trade were that I came in too heavy. You know, even though I made 30 grand on this trade, if I really wanted to give this trade 5 stars, I would say it would have ended with a $15,000 profit and reducing risk initially. So coming in lighter in position size. Okay, so all in all, this was a record trade at the time. It was $30,000. I'm sure you guys have seen me post that trade all over the place. I was super proud of it. All right, guys. Well, that was your trade.
All right, and props to Tori Trade for such a banger trade. And you know, just so you know, like, it doesn't stop there. This is actually a $40,000 trade that she closed. $40,000 in one trade. So if you want me to review that one, let me know in the comments and I'll review that one next time. Thank you so much for watching this video. I'm Brent. If you want more info on my strategy, I break down my 3 favorite trade setups and I break it down for you for free in a downloadable PDF at tradesbybrent.com/3setups. You can also go to the link in the description. And if you want to trade with the tools that I'm using, hit the link in the description as well. And I'll link you out to the favorite tools and strategies that I'm using. You can also hit me on the socials at tradesbybrent. Like the video if you liked it. Hit subscribe if you want more. And I'll see you next time. Thanks for watching. The 2 biggest problems day traders face are number 1, finding a profitable strategy, and number 2, mastering trading psychology. This video is going to be a deep dive on how to master number 2. Now, why master trading psychology? Because consistency. The more that you can master your trading psychology, the more consistently that you can do well in trading. It's one thing to learn how to profit from a trade. It's an entirely different thing to be able to do that consistently. And to show us how to master trading psychology, we're going to learn from the best teacher of trading psychology of all time, Mark Douglas. I want to introduce you to this man because Mark Douglas is a name every serious trader should know about. And if you've never heard of him, it's probably because he's dead. He actually passed away in 2015. May he rest in peace. So I'm incredibly grateful to be able to pass on some of his teachings to you. He was a pioneer in understanding how the real battle in trading is not on the charts. It's in your mind. And he didn't just talk about discipline or mindset like you've heard from everyone else. Instead, he figured out how to break down the hidden ways that our emotions sabotage us. And he will show us how to reprogram our thinking to build the kind of consistency that separates the winners from the losers. So if you've ever felt stuck, taken over by your emotions, or unable to stick to your rules, listen very closely to these principles because this right here could be the turning point in your journey. With that said, meet Mark Douglas.
My name is Mark Douglas and I'm the author of The Disciplined Trader and Trading in the Zone. I've been a trading coach since 1982, and over the years, I've worked with some of the industry's biggest hedge fund and money managers, as well as some of the exchange's largest floor traders. I know that all of you want to experience consistent results from your trading. In other words, you want to be able to generate an income you can rely on. However, one of the major obstacles in trying to accomplish this objective is in the area of trade execution. To produce a consistent income, a trader has to be able to execute their trades without making any errors or mistakes. In other words, trading without hesitation, reservation, or internal conflict. Basically, all of the errors we are susceptible to are a result of a lack of confidence, or more specifically, trading with fear. What most people don't realize is that trading without fear is actually a learned trading skill, a skill that has to be cultivated and is the primary difference that separates the professional from the typical trader.
Okay, so let's outline his key points here. Number one, consistency is the goal of trading psychology. And of course, by that, we mean consistently profitable. Number two, consistency is the result of eliminating trading errors. And number three, trading errors come from two places: fear and lack of confidence. For example, internal conflict and hesitation. And the last point, which is the most important one, this is all a learned skill. I'll say it again, this is all a learned skill. And he says if you don't believe him, like you don't just buy this whole trading psychology stuff, don't take his word for it, and don't take my word for it. Do this experiment to test it out and see for yourself. Set up a paper trading account, perform your exact trading setup on a simulator, let's say for a week, and see how many errors you make. You'll notice you make very few. Now go to a live account or prop firm account, your choice, and execute the exact same strategy, exactly the same way, and you will find that the amount of your execution errors goes up significantly. Now, how could that be? The answer is, of course, trading psychology. So that's evidence that this is absolutely a learned skill, and it is exactly what is missing in your performance between the simulated and the live account. And the good news here, and the reason why I'm doing this presentation, is because it can be learned. So if you're dealing with these problems currently, know that you can transform them and create a breakthrough for yourself and your trading results by gaining this new skill. Now, speaking of consistency, let's get to the 7 principles of consistency. Mark Douglas came up with something, the 7 principles. His 7 principles of consistency and the 5 fundamentals, they've helped me more than anything. They're outlined on your screen here. And if you want to download this free infographic, watch to the end of this video and I'll share a link where you can download this for free. How do you master trading consistency? And how can trading psychology help you? The first thing you have to do is you have to identify your edge. This is the foundation of consistent trading. There's no consistency without defining your edge. Now, a lot of traders, they maybe have learned about trading and learned about trading strategy, but maybe they're not actually clear on their edge. Are you? So that's an important detail. You need to know what your edge is. Now, what's an edge? Your edge is your setup. That's your setup. Shout out to my man Bobby from San Diego. I'm in San Diego too, man. Your setup is a technical pattern. That's the pattern that you look for, right? So you have to understand it well. And when you understand what that pattern is, what you should know is what the probability is that favors your setup, right? So this is how you systematize your trading. And this is a really simple way of seeing it. You go, okay, I wait for this setup. When I get this setup, I know that means the odds go in my favor about this, okay? And obviously, it means that the odds are, you have better than a 50% probability. But sometimes you can do a little better than that. So there are certain times in the market, right, when it's trending heavily, for example, and it's more than 60% or so probability. So you want to have a basic idea of when the odds are in your favor and what the pattern it is that you look for. That's your edge, and that's how you define your edge. And so if you don't have this to define, then there's no point in working on your trading psychology. So this would be step 1. All right. And shout out to my man Glebo. He's tuning in from Northern Germany. Good vibes only. Very good. Yes, yes. Oh my God, there's so much negativity on the internet, right? This will not be one of them. In my experience, as far as my edge goes, I have 3. Now, if you have subscribed to my 3 setups, you can get those for free at tradesbybrent.com/3setups. You can see my 3 setups. But my favorite setup is a pullback setup, and that's for trend continuation. And that's setup number 2 in that downloadable document, which you can get. I give it away for free. And when that happens, I know that when the market is in a trend and it pulls back, that it often offers a high probability entry point. So that's when you get, say, a leg, you call it a leg, in one direction. The odds of a second leg after it pulls back for trend continuation is somewhere between 60% and 90% odds. It's going to be around 60% most of the time, but it can be as high as 90%. That's when there's high level of momentum. And this clear edge gives me the confidence to execute and assume risk. So that's why this is important, because you just know that the odds are in your favor. And when the fear comes up, you can take that risk because you know that the likelihood of winning exceeds the likelihood of losing. It's simple, but it works. All right. So now that we've talked about consistency and edge, let's talk about predefining your risk. So I'm just going to share with you guys. I'm going to share with you guys the 7 principles of consistency. Okay. So you're going to want to write these down because you're not going to see them on the screen. I'm just going to tell them to you, and you're going to have to do some, you're going to have to give it some effort here. Okay. So here are the 7 principles of consistency from Mark Douglas, and these are gold. So you want to remember these and write them down. The first one is number 1. I objectively identify my edge. So we just talked about that, right? You can objectively and clearly identify what your edge is. That means your setup, okay? Number 2, I predefine the risk before every trade, okay? So we're going to talk about that in a minute, but that's rule number 2. Number 3, and I'll give them all to you right now. Number 3, I completely accept the risk, or I'm willing to stay out. I completely accept the risk, or I stay out. Number 4, I act on my setup without hesitation. I act when I see my setup without hesitation. Number 5, I pay myself as the market moves my way. In other words, I take profits as the market moves my way. Number 6, I continually monitor my susceptibility for making errors. Number 6, I continually monitor my susceptibility for making errors. Number 7, the 7th principle of consistency. I understand the absolute necessity of these principles of consistency, and therefore I do not break them. Okay. So principle number 7 is I don't break the rules. Okay. Rule number 7 is I don't break the rules. All right. So I'll go through these one more time very quickly. The 7 principles of consistency. And again, credit to Mark Douglas. Number 1, I objectively identify my edge. Number 2, I predefine my risk before every trade. Number 3, I completely accept the risk or I stay out. Number 4, I execute when I see my edge without hesitation. Number 5, I pay myself as the market goes my way. Number 6, I continually monitor my susceptibility for making errors. Number 7, I understand the absolute necessity of these rules and I do not break them because these are rules of consistency. Okay. So those are the 7 principles of consistency. I'll give them to you all right now, and get those and apply these. And if you want, work on one each day, right? So Monday, you'll work on objectively identifying your edge. So you should have your edge identified. And then Monday, you just practice. Okay, there it is. There's my setup. There's my setup. There's my setup. There's my setup. On Tuesday, every single trade, you say, okay, I'm going to set that stop loss before I enter the trade. And you practice doing that and make sure that you do not enter a trade unless you're entering with a stop loss. A good way to do that is bracket orders. If you don't know how to use those, make sure you learn how to use bracket orders. Number 3, I completely accept the risk or I stay out. So that's another great one to practice. So now we'll be on Wednesday and you'll just look at a trade and you'll say, either I enter or I don't enter. Just make it very black and white. Okay. And then you can go down the list and you can practice one every day. So that's a suggestion for you. Now let's talk about predefining your risk, taking control of your trades, but make sure that you guys are with me. So post some dollar signs in the chat if you're with me so far. Okay. Post some dollar signs in the chat if you're with me so far. So I know that the sound levels, the volume's coming through loud and clear. Make sure that, yeah. Okay, good. Okay. Now, taking control of your trades, predefining your risk. Before entering a trade, you determine your stop loss level. Now, this means you have to make sure that if you're an optimist, that you include some pessimism, okay? You have to include some pessimism because in trading, you need to be both optimistic and pessimistic. Okay, good. We're seeing dollar signs in the chat. That means you're with me. Beautiful. So You need to define your stop loss before you enter. This is a rule that everyone needs to be applying. Now, some people think this isn't important and they're idiots. I'll say it right now. I'm not trying to be negative, just saying that's like speeding on the freeway without a seatbelt. You would not do that. Okay, so you need a stop loss just in case, So you define that stop loss, which is your maximum potential loss, allowing you to manage your risk effectively. This is effective risk management 101. The lesson learned is I once missed a profit target due to not having a predefined stop loss, and the trade moved against me. Okay, then that caused a significant loss. And I learned that without predefining a risk, you're essentially gambling. Okay, that's really the bottom line. So the difference between a professional and an amateur is they're thinking about the risk. So if you're not thinking about the risk, start thinking about the risk as well as the reward. They're both equally important elements of trade structure. And two, if you're not thinking about risk, challenge yourself to think about it more clearly. And Glebo in the chat says he has a trading buddy who helps him. He's pessimistic and it gives him balance. That's good, Glebo, but you need to make sure that you're working on developing that cognitive skill within yourself, right? You should be able to look at the trade and say, okay, counter logic. I see it this way, but then I see it this way. If I'm right, then this will happen. If I'm wrong, then this will happen. So that way you're using your brain both directions, back and forth, because trading is buyers and sellers. So you want to be able to move your mind and be very flexible and agile in your thinking so you can go back and forth. Okay. So next is accepting risk. We're talking about predefining your risk. Now we want to talk about accepting the risk, because once you predefine the risk, now you enter the trade, right? And if you predefine your risk, well, then some fear might come up, right? So there's 3 levels to this, to accepting the risk. Because when we talk about accepting the risk, you're talking about embracing uncertainty and taking action. Because when that setup's there, once you define the risk, then fear can come up and it can stop you. So level 1 is acceptance. You have to accept it. Then you have to execute it. And then you have to be confident, right? Because another temptation once you execute and you're in that trade is to panic out. You don't want to do that. And I've struggled with that. And I'm still working on that, honestly. So you want to work on this. We all should be working on this. And by accepting the risk of each trade, you'll be able to execute with more confidence. So you should start thinking of yourself as more like a rule-based machine. You go, okay, if this, then this. If this happens, then I do this. If this happens, then I do this. And you just start learning a more machine-like way. That's really how you become a more effective trader. 3 levels of accepting the risk. The first one is acceptance, right? This is how to embrace uncertainty. Accept the risk, then you execute, then you have the confidence. And the confidence allows you to not panic out, right? Because the problem with trading is you have so much control, right? You can just panic out, and it's the hardest part about trading because you have total freedom. Like you can panic out of any decision that you make, and that's how people get tilted and how trading psychology goes down the drain and how people can lose a lot of money. You don't want to do that. You want to have confidence. The trading will test your confidence hugely. So you want to make sure that you're willing to stick with the decisions you make. This means understanding that losses are part of the process. And what do? You don't try to avoid losses like you're afraid of them. You focus on your edge instead of fearing potential outcomes. Okay, so let's move on. Acting on your edge without hesitation. You trust your system, right? Why do you define? Claudio, what's up, man? Long time no talk. Shout out to my man Claudio from Germany. Now, you want to act on your edge without hesitation, right? So you trust your system. This is how you attain consistency. You trust your system. First, you start with doubt, then there's hesitation, then there's a missed opportunity. And you can see that it inches up, right? So once the doubts come in, the doubts are like the breeding ground for hesitation. The hesitation's the breeding ground for missed opportunities. And that's when the FOMO kicks in. And that's not what you want. Okay? So the second that you have doubt come in, you want to kill it and say, no, I trust my system. Okay? Overcoming hesitation and trusting your system is crucial. Second guessing can lead to missed opportunities, and it often stems from a lack of confidence in your edge, right? By your edge, we mean your system. So you trust your plan. That allows you to act decisively and capitalize on market opportunities. Are you with me? If you're with me, type hell yeah in the chat. Next, feedback from the market. So now we get into adapting and evolving. Three parts here. First, observe, then adapt, then profit. Once you get feedback from the market. So this is when you enter a trade, pay attention to the feedback of the market. How does the market react once you enter? How does it react? Are you seeing patterns in its behavior that influence your decision? So if you think the market's doing something, like you think the market's trending, for example, and you enter expecting more trend, and then the market does the opposite of what you're expecting, is that influencing your decisions? And are you changing your process based on what the market's doing? Or are you figuring out how to work with the market and how to still follow your process regardless? Okay. The next part is adapt. What you want to do is embrace a growth mindset. There's two types of mindsets. People have fixed mindsets or growth mindsets. Fixed mindset means people are just the way that they are, and that's how most people think. And then there's the growth mindset, which means you're always seeking to learn and improve, and that failure are opportunities for growth. So that's growth mindset. And if your trade isn't working, you want to consider adjusting your strategy based on the market's feedback, but not to the point where you're breaking your system. I want to make that very clear, right? So if you enter on a pullback, you want to consider, for example, entering in a different location, right? Or maybe that you missed the setup, and then that's okay. All right. So that's the adaptation phase. And then there's the profiting phase. So by adapting and evolving, you make better trade decisions and increase your chances of success. So you don't want to be rigid, but you also don't want to be abandoning your system as well. There's a certain level of adaptation and flexibility, and there's a certain level of rigor and discipline that needs to be applied in equal measure, probably. Okay. So that's adapting and evolving. That's key. That's important. Let's keep moving. The next is detaching from the outcome. Now, one of the most important things that I've had to learn that I really struggled with is just trusting the process. Trading consistently well is all about process, and it's all about executing a process over and over and over and over again. Okay. So two keys here that I want to share. The first one is focusing on the process, and that's your system. So once you have that setup predefined and your risk management strategy is in place, the outcome of each individual trade is less important than your overall consistency in your approach. Okay. So you don't want to be nitpicking and really criticizing yourself. And that's one of the things that I've struggled with the most, because I'm a big perfectionist. So I've had to like change this and learn how to be less critical of myself and more accepting of myself when I fail or when I don't execute perfectly, which is often, right? Because you're a human being. The next part is accepting losses. Now, losses are inevitable. Amateurs have no understanding of this at all. I see it in the comments on the YouTube channel all the time, right? They think a loss is bad. It's not bad at all. You know, losses, it's like inhaling and exhaling, right? Like you need both, and you're going to have wins and losses in a trading strategy no matter what. And a higher win rate doesn't mean that you make more money, because there's traders with an 80% win rate that are actually losing money and they're not even profitable. And there's traders with a 40% win rate that are wildly profitable because their average win is bigger than their average loss. Think about the math on that. So win rate is less important. It's really not that important. And if you want to learn more about this, I strongly recommend you go onto my YouTube channel and watch the video called "You've Been Lied To About Your Win Rate," where I show stats from actual traders proving this mathematically. Okay. Now, next, embrace losses. Just embrace them and be willing to learn from them. And sometimes be willing to accept them without there being anything to learn, because some losses are just part of the strategy and you should accept that. Okay. All right. Maintaining a consistent trading routine, discipline, execution. Now, 3 phases here: planning, reviewing, and rewarding. Planning, plan your trading day. This means you need a pre-trading ritual. You need some rituals that you do. If you've seen my videos on this, then you know I have a very extensive morning routine that I do to get my head in the right place. So you plan your trading day, then you define your entries and exit points, and you set your stop loss. That's your risk limits, okay? This is the structure for creating a trade that is disciplined, okay? And for this, I recommend you just use bracket orders. Easy answer, okay? Then you review. You review your trades, you identify areas for improvement, you make adjustments in your approach. This ongoing analysis ensures consistency and growth. Then number 3, you reward. Celebrate your success and acknowledge your progress. Positive reinforcement keeps you motivated and encourages consistency. And I'm not a huge fan of this part, but it is important to acknowledge yourself. Although it's also just as important to raise the bar once you reach one of your goals. And that's something I'm thinking about all the time. All right. So that's a little taste of Mark Douglas's 7 principles. Okay. And we don't have time to cover all of them, but I will go over them with you again right now so that you can write them down. 7 principles of consistency. Number 1, I objectively identify my edge. That's your setup. Number 2, I predefine my risk before entering any trade. Number 3, I completely accept the risk or I stay out. Number 4, I execute my setup without hesitation when I see it. Number 5, I pay myself as the trade goes my way. Number 6, I continually monitor my susceptibility for making errors. Number 7, I understand the necessity of these rules and I do not break them because they are what allow me to be consistent. Okay. So those are Mark Douglas's. That's my take on Mark Douglas's 7 principles of consistency. Now let's talk about the 5 fundamentals of probability. Okay. 5 fundamentals of probability. Bobby, I have many live trading sessions on the channel if you want to watch them. Many hours. The 5 fundamentals of probability. Number 1, anything can happen at any moment. Number 2, don't need to know what's going to happen next to make money. Isn't that interesting? You don't need to know what's going to happen next to make money consistently. Why? Why would that be the 2nd fundamental rule of probability? Because it's probability, right? It's statistics. It's forecasting. You don't have to actually know what's going to happen. You just know that if you have a 60% win rate, let's say 6 out of 10 trades, you win over time. So that's how you get rule number 2. Rule number 3, there's a random distribution between wins and losses for any set of variables set that defines any edge. Okay. This is basically saying that wins and losses are basically random until you zoom out enough. So you don't get caught up in the wins and the losses. Number 4, an edge is nothing more than an indicator of higher probability. That means one thing's more likely to happen than the other. And number 5, every moment in the market is unique. Every moment in the market is unique. So number 1, anything can happen at any moment. And number 5, every moment in the market is unique is basically the same thing. Okay, so those are his 5 these are Mark Douglas's 5 fundamental rules of probability. Why am I sharing this with you? Because I want to show you that this guy is unlike any other person teaching trading psychology. This guy lost hundreds of thousands of dollars trying to learn how to trade. Not only that, he lost his wife and he lost his house. Okay, this is no joke. And that's why this guy is someone you should listen to. Because he's been there.
I started trading like that. I went through, I don't even remember what my first trading account was. I think it was around $20,000. You know, I lost all of that and then, you know, saved up some money and opened up another one for around 15, you know, lost all of that and then went to another broker and I'm thinking this guy doesn't know what he's doing and I'll find somebody who does. And then this is what really, this is probably the reason I'm even standing here today, was this particular trade, because this particular trade it had a profound impact on me in terms of how it changed my life and what I was willing to do to find out what this was all about. To find out really what does it take to be a consistently successful trader? What does it take to really be able to earn an income as a trader? In 1980, I think, I was long silver at around $9.75 an ounce. And there's 2 5,000 ounce contracts at the COMEX. In other words, I was long 10,000 ounces of silver at $9.75 an ounce. And right after I got into the market dropped about 20 cents on me to about $9.55. So I was down $2,000. And my broker said, well, okay, you know, here's what we're going to do. Instead of getting out, we'll put you into a spread. And so what we'll do is you're long 10,000 ounces of silver in New York. We'll go short 10,000 ounces of silver in Chicago because you could trade Chicago silver at the Chicago Board of Trade. Everybody with me on this? Just want to make sure that you guys are all with, even though I know many of you are stock traders, the concept is the same, okay? So I'm long 10,000 at 975. He puts me short 10,000 at 955 in Chicago. So I've got this spread going on. And then he said, well, when the market goes back in your favor, we'll just take the short leg of the spread off. Now, keep in mind, back then, you guys are. What do you typically pay for commissions, even in commodities, or even I don't know what you'd pay for stocks, but typically the average commission is about $4 to $5 a round turn, right? How much do you think we were paying back then? Yeah, 125. How's 125 a round turn per contract? So in other words, for me to put this trade on cost me $250. Okay, when he put this one on right here, it cost me another $250. And then he said, of course, that when the market goes back into my favor, he'll take the short leg of the spread off and, I should be all right. So that's exactly what the market did. The market went back up to, right around the 975 area. He took the short leg of the spread off, and then the market immediately dropped back down another 20 cents and put the short leg of the spread back on again. So that's another $250, okay? Plus, he just locked in, when he took this off, first of all, he locked in a $2,000 loss by putting this trade on. When the market went back up to 975 and he took this off, he locked in another $2,000 loss. And then when it went back down again, he put it back on and locked in another $2,000 loss. Now I'm down $6,750. Okay? And then, of course, it happened 2 or 3 more times. Now, from the market's perspective, all the markets, the silver market's just in a trading range. That's all it is. It's just in a trading range. But I didn't know how to read chart patterns at the time and didn't really understand what was going on. I was just listening to him. And so what he was doing was just taking advantage of the fact that it was going back and forth between support and resistance and generating commissions for himself, okay? That was it. That's basically, he was just turning my account.
So he's watching the market bounce up and down between support and resistance. Support here, resistance here, trapped in this rectangle. And every time the price hits one of these levels, he's executing another trade and another trade and another trade. And he doesn't realize it's just a pattern, up, down, up, down, up, down. And the market is just screaming out, hey, we're in a trading range, just like this is right here, right? But he doesn't know what's happening. And while he's getting slapped around like this, his broker is happily collecting thousands of dollars in commissions. Now, for you watching this right now, here's the kicker. You can learn every psychological principle that we're talking about here. Every single one of Mark Douglas's 7 principles. But if you don't understand the basic chart patterns like a trading range, this is a trading range here, and this is a trend. If you don't learn the basic difference, where you can look at a chart and tell the difference between this and this, you're setting yourself up to fail. And think about that. You have to know when the market is stuck in a range. Otherwise, you're just pressing buttons, guessing when the price is going up or down, and just bleeding out money, just like Mark Douglas did. It was brokers back in the day, but now you'll just be at home over trading and end up blowing your account. So as we continue to master the mental game of trading, the psychology, make sure you also know the fundamentals, especially the difference between a trading range and a trend, because it is not an advanced concept at all. And knowing something like this could literally be the difference between continuing to make money in your account or blowing it all.
But here's the story, is that as these losses are mounting, okay, and I can't sleep and getting real stressed out. I wake up one morning and I thought, you know what, this is it. I just can't take this anymore. I just can't take it. And so, when I got to work, I called them and I said, you know what, just get out of the whole damn thing. I just can't do this. So just liquidate the position. Does anybody remember the Hunt Brothers silver debacle? Oh, it didn't. Does anybody, if I say the word limit up, does anybody understand what I mean by that? Okay, the exchanges will impose artificial price limits of how much a commodity, or even a stock for that matter, can fluctuate in any given day before they stop trading. So we don't have these kinds of moves too much anymore, but back in the 80s, limit moves were really quite common. They really were. In other words, what would happen is this: is that if the market went up, let's say, I think in silver it was 50 cents. I don't remember exactly what it was, but if the market went up by 50 cents, they would actually stop trading. Meaning, if the market was bid up to, let's say in this case, $10.25, trading would stop. In essence, what this means is that at 10:25, there were no people, there wasn't anybody in the world, there wasn't, now this is important for later on, there wasn't one person in the world who was willing to sell silver at 10:25 if it was a limit move. Not one person. And so what happens is that the market, the price will go up seeking to find who will actually sell. So what the exchanges didn't want is the exchanges didn't want there to be this huge fluctuation all in one day. There might have been sellers at 10.26, or there might have been sellers at $11, but you don't know that because the exchange says we're going to stop trading at 10.25. You guys with me on this? Okay. So what happened is that I don't think it happened more than maybe half an hour, 45 minutes after I got out. The market was trading right around $9.75 an ounce. Where silver went limit up. And went limit up, was 30 days in a row to $49 an ounce. To $49 an ounce. I was looking, now think about this, okay? Now think about being in this kind of a winning trade. Now, when we're in a winning trade, the market almost never goes straight up and it never goes straight down. There are rare occasions, of course, like in this case, when it does. So that when we're in a winning trade, we have to constantly be making decisions about where we're going to take profits and how much heat we can take with the market coming back against our position to say, well, is this a time to take profits? Or am I going to let it come back a little bit further? Am I going to come back a little bit further against me? Because, well, is this normal retracement or is this more significant, okay? Is this a little bit of a profit-taking retracement? Is it more significant? Should I get out now? Do we have more left? Are we going to make new highs? You got to be making all these kinds of decisions. And it's very difficult, as we all know, right? See, in this case, I didn't have to be making any decisions because the market went limit up 30 days in a row. Boom, boom. So I sat back and watched in complete agony. I mean intense agony. All I know is that I was within, let's say, a half an hour, 45 minutes of a monster trade. A monster trade. And like I said, I sat back and watched in agony as the market went up to $49 an ounce. I'm thinking to myself, I was like that close to $400,000 on just 2 contracts. $400,000.
If you want to download the infographic for the 7 principles of consistency, hit the link in the description and I've got it there for you for free. This was just an introduction to Mark Douglas. So if you want a part 2, let me know in the comments. Thank you so much for watching. Subscribe for more videos like this. Hit that like button if you liked the video. And if you didn't, that's cool. See you next time. What's a simple thing that you can implement into your trading that will have an immediate impact on your results? One simple entry technique that can instantly explode your win rate. That's a very, very simple thing. We're not talking about any complicated analysis. No, nothing like that. This is very simply waiting for the candle close. Now, I talk about this all the time. And in this video, we're going to review always waiting for this before entering trades from GeaFX. We're going to discuss this technique. It is my goal in this video to convince you that waiting for the candle close is one of the simplest and most effective things you can do to explode your results and explode your win rate. Now, your results are up to you, but I'm going to show you some reasons why this is something you should implement, I think, or any trader should at least consider very seriously, because by not waiting for the candle close, there's some very serious consequences. So let's get into it.
Video if you want to stop losing trades pointlessly. I'm going to teach you about closures, why they're important, and how you can actually use them to validate trades, avoid losses, and make big wins. So let's not waste any time. We'll get straight into it now. So first things first, what is a closure? Well, if we're looking at a 1 hour chart here, let's imagine these candles are hourly candles. That means every hour that passes, a candle will form. And at the end of the hour and the start of the new hour, the candle will close. So for example, this would be our closure. This would take place at the start of a new hour. this would be the open price of the next candle.
Simple. 1 hour chart. Every candle's 1 hour. That means you get one close at the end of every hour. Simple, straightforward, easy, right? Now, let's keep going.
At the end of that hour, once again, we get a closure, and this continues. We get a closure and open at the start of each hour.
Yep.
So a candle closure is just where the candle is when the new candle opens.
That's right. And if it's bullish, it's going to close. It's going to be up here, right? And then if it's bearish, it's going to be down here, right? That's what defines whether it's a bullish or bearish close. A bullish or bearish close.
The closure is here. The closure is then there, 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 there.
Okay, so for any new trader, this is what defines the color of the candle. The color of the candle changes as soon as the candle closes, okay? So if it closes up here, then that's going to be bullish. If it closes down here, then that's going to be bearish. And as soon as that close happens, then the candle color is confirmed.
And all the way up there, okay? Now, the reason we need to wait for these closures is because until a candle closes, it can reverse on itself. Now, if we take a look at...
Okay, so this is the first reason why you've got to consider waiting for a candle close, because it can reverse on itself. And if you haven't been trading or you haven't placed any trades, then you have no idea about this. But when you start trading, you see this very quickly, that the appearance of a candle can look one way for the entire candle, and then right before the close, a few seconds into the close, can completely flip on you.
In this instance, we're in an uptrend in this example. The market's uptrending, we formed a high. The market then came down, formed a higher low. Now the market's pushing up to form this potential higher high.
Okay.
If the market was able
so the prior high was here. Now we're forming a higher high here.
to close over this swing high, that would open doors to continued uptrending movements, meaning we could continue buying this market because we know it's going up, because it's continuing to make new higher highs. But if the market does not close above, and instead the market does this and pulls back down before that hourly candle closes, if it closed down here, then this would actually be a rejection of the high.
Why is that? Because this tail on the top of the candle, or wick it's also called, right, actually shows selling. If you look at a shorter time frame, this is a 1 hour chart, but if we were to look at a shorter time frame, like a 5 minute, we would see bear closes here because this now becomes a resistance area.
Because when we're looking at candles, we have the bottom.
So let's just look at that. Okay, we've got two different scenarios. We've got one scenario where the candle closes on its high above a prior high. And he's saying that's a bullish indication. And it is a bullish indication, okay? Because it's showing buying into the close. So what you want to do as we continue this video, what you want to start to think about is, what are buyers and sellers thinking as we come into the close of a candle? Now, if the chart is a scoreboard and there's bears and bulls and each candle close is a point on the scoreboard, that's a really good way to think about this.
Continuing to make new higher highs. But if the market does not close above, and instead the market does this and pulls back down before that hourly candle closes, if it closed down here, then this would actually be a rejection of the high.
Okay, so that's more of a bearish sign. So now look at this. The candle color is the same. Candle color is the same color. This is a bullish. So on most people's chart, this would be a green candle. Okay, this is a bullish candle. He's got the colors changed because I don't know, whatever. He's different. He's different. Okay, but if you have the same pattern with the same candles, however, the close is different. The only thing we changed in these two scenarios, look, same setup, everything looks exactly the same. But we're saying if the candle closes up here, then this is a bullish indicator. But think about what buyers and sellers are thinking. That means that there was buying into the close of this candle. Okay, it closed almost completely on its high, which means buyers are confident if they continue to buy through this hour. Remember, it's an hourly chart. So they're buying through that hour and they're still buying a few minutes towards the end of that hour, right? That shows high bullish conviction. However, if we take everything the same, all else equal, and we just change one factor, the candle close, this is actually a bearish indication. So this is the first reason and the first lesson here that we want to really start to think about. Oh, okay, the candle close is actually incredibly important information, and it may be the most important data point on this whole chart. Notice it's even more important than all of this down here, and this could change again in the last few seconds of the candle close. So you could think it's one way, and then in literally, if it's a 5-minute chart, it could be the last 30 seconds. And the whole thing could flip.
On top or below candles. Wicks show attempted prices within a given time frame. So in this instance, this wick shows us that the market attempted to go this high, but it actually got rejected and the closure ended up being here.
Showing a resistance zone up here, right? Because it tried to move up and there was resistance.
Now this means that the only confirmed price action within this price range is between this low, the open price, and this high, the closure price. Anything above that was just attempted price, also known as rejected price. So this is rejected price action, and then this is confirmed price action, just here. Now, what does this show? Well, this shows the confirmation has actually confirmed lower than the previous swing high, and the only push above that we had was a wick, which was rejected. So this market attempted to push higher but failed to close above, which actually rejects entirely the concept of seeing closures and continuations above this level, and instead suggests that maybe we could move even lower, because we
So it could literally be the opposite.
haven't closed above the high, so we've rejected a new high, maybe indicating that we could be ready to turn into a downtrend. Now, if you saw this candle while it was open and it's moving up and down, and you decide to buy this candle before it closes because you think that it's closing above the swing high, well, if the candle then pushes all the way back down here.
Okay, see what he just did there? That's actually what it looks like when you're trading. And again, if you're not trading and you really haven't experienced the live markets, I don't mean watching videos on YouTube, I mean actually trading, okay? That's more like what actually happens when you're in a trade, okay? You think that this baby is going up and the candle goes from here,
Think that it's closing above the swing high. Well, if the candle then pushes all the way back
to there in like 10 seconds and you're like, oh, baby, and you actually bought all the way up here and now you're sweating.
Down here, you've bought on unconfirmed price action. You've actually bought into a rejection of higher prices.
Okay, so simple answer why you should wait for a candle closes before your entry, because it's confirmation. A candle closes, confirmation. You have an idea as you're looking at the chart and as that candle is going up and down, but only until the candle closes is what you're looking at confirmed. If the candle hasn't closed yet, it's not confirmed. So just think about this with simple logic. Isn't it better to wait for confirmation of what you think is going to happen? Isn't it better to wait for confirmation? Or is it better to not wait? I'm arguing to you and I want to convince you that it is always better to wait for confirmation. And it doesn't necessarily have to be on the time frame you're looking at. It could be a shorter time frame. We'll talk about that in just a minute.
Which means the likelihood of your trade working out and not instead doing this is now considerably lower. And it's likely.
So it lowers the probability is what he's saying, because every candle close shifts the probability. So if the candle closed up here, then the probability for a bullish move is higher. But if the candle closes down here, then the probability for the bull significantly drops.
This trade could reverse on you. So if you bought up here during this push up, you had your stop loss here, well then it's very possible the market could even sink and stop you out of your
Easily, that could easily happen.
trade without actually playing off at all. If you wait for the next hourly candle to open, so you wait for a closure and the next hourly candle opens like this, for example, well now you have that confirmation. So the likelihood of us continuing even higher is actually now pretty much set in stone and a lot more like.
It's not set in stone. Nothing in trading is set in stone. So pretty much, yeah. Let's emphasize the pretty much.
Because the market has proven to us that it's ready to make new highs. So that's why we need to wait for closures. Because if we don't get a closure and instead we get a wick, well then it's likely that the market will flip on us.
Okay, so here's a couple more rules for looking at candle closes. We talked about waiting for the candle close and we've established some reasons as to why. Yes? Yes. Okay, now here's a couple more things to consider. One, did the candle, and he's hinting at it right here, did the candle close on its high or did it not close on its high? Thing one. Thing two, did it close above its midpoint or did it close below its midpoint? Now, if it closed as a bare minimum, if it closed at least above the midpoint of the candle, then we can say that that's a bare minimum confirmation of what we're wanting to see if it's a bullish candle. Okay, now this example here, it didn't even close above the midpoint. So if the candle can't even close above the midpoint, then that's a very weak signal. So bare minimum, did it close above the midpoint, ideally on its high, or did it close below the midpoint? And then if it closed below the midpoint, then we have to start to consider that this bullish close is actually more bearish than bullish.
Or at least the probability of the market flipping on us is a lot stronger than it would have previously been.
Yeah.
which means you can get caught up buying against movements like this that could
And get absolutely wrecked. And you don't want that to happen. So this is very important.
instead actually lead us into a new downtrend. So following on from that, if the swing high was rejected, telling us not to get into a buy trade, and then the market moved lower and pushed past the previous swing low, well, this could potentially open the doors to trading the other way, which could completely flip our bias. And if we were aware of this and we waited for confirmations, we'd be able to take advantage of this new bearish price action. But what could also happen is actually we go and reject the low as well. So taking a look down here,
which is likely. Now, why would a rejection down here, or a reversal is what we're talking about, why would that be important? Or why would that be possible, right? Why is he saying that that's a reasonable expectation, which is basically what he's saying? Because look at this. We went all the way up and then we went all the way down almost, okay? Almost all the way to that low. So this is technically a higher low because this is probably a couple points, a few ticks above here, but that's how strong the bulls were. The bulls were not very strong. The bulls allowed the bears to get all the way down here, showing very, very bearish, okay? So this chart is strongly bullish and it's strongly bearish, and the bulls only kept the price above this prior low by like a tiny margin, okay? So this actually looks more like a trading range. Now, what happens in a trading range is traders buy at the bottom, which is support, and they sell at the top. He's calling that rejection. So if you see this very strong bear bar closing on its low here, the possibility of there being buyers down here, support, this is actually a possible support area. And I would say it's a likely support area. But we have to, again, the theme of this video is looking at the candle close and taking that into consideration when we are thinking about what's going to happen.
Say we pushed down initially, we formulated some bearish price action, but then before the candle closed, we had a push back up like this, and then we closed as a bullish candle once again.
Okay, so now that actually looks more bullish, doesn't it? Okay, and what he showed there, how he's simulating this, I really like this because that's usually how it happens. It happens like that. It's like swinging all over the place when you're actually trading.
Well, now we are seeing the same thing again. We're seeing a rejection of this swing low. This is basically showing an area where sellers were pushing the market down, but at some point down here, buyers took massive control of this market and ended up running it back up to close at this point.
Which is what we mean when we say support, right? Look down at the floor. Notice the support's holding you up, okay? Same idea right here on the chart. Support, holding the price up.
If, following on from this point, we then had a bullish candle that managed to go up and close above that previous swing high, so we'd be looking around this point here, well, this would then validate the buys, finally, okay? Because what we've actually shown is an attempt to go higher that failed, then we had an attempt to go lower, which massively failed, followed by an attempt to go higher, which succeeded with this closure. And if this candle was to close up here, then we could continue with our bullish ideas, potentially looking to buy on pullbacks to take this market higher. So really, we have to wait for closures because you've seen just how dynamic this market has been. And in this example I've just showed you, how you could have been tricked twice if you hadn't waited for candles to close. First, at this top point up here when the market rejected the high, and second, when the market rejected this low.
You don't want to get tricked. That's another reason, right? This is a very, very simple reason why you should wait for candle closes to enter, because you don't want to get tricked.
Now, obviously, this can be a big back and forth, which can be hard to get your head around. But really, it can all be solved by just waiting for the candle closures like this that we see here. Because if we wait for a closure above or below a swing point, then we have the confirmation we need to understand whether a market is building strength in one way or the other in a meaningful manner.
Okay, now I want to show you an actual real example of this, okay? So let's go to my charts. I use TradingView, and if you want to use the tools I use, go to the link in the description. I've got a link to TradingView. I think this is the best platform. I've been using it for years. So let's say you're trading this, right? I'll give you an example here, and we'll break it down similarly. This looks bullish, doesn't it? Why? Because all the closes are above the moving average. All of them, okay? Now, as soon as we came down here, there were buyers at the moving average. We can see that because there's wicks on the tails. He was just talking about this, right? Price came down and then rejected up, and the bulls were actually able to keep the price above that blue line, which is the average price. So that looks good, and it looks like the momentum from the bears is kind of waning, right? But watch what happens next, okay? Now, next, we get a candle that immediately sells off. right? Immediately sells off, right? So now if we're saying that what defines, better said, if we're saying what indicates a bull trend is that most of the closes are above the average price, or either the VWAP or the EMA, whatever you use. If most of the closes are above that, then we're going to consider that bullish. If most of the closes are below it, then we're going to consider that bearish. Then what just happened right here is we have our first possible bearish sign. So although this looked very bullish, now we actually have a bear bar closing on its low and closing below the moving average. So now this is actually starting to look more bearish. But watch what happens next. Next, we move forward and we start to see that, oh, there's actually a tail on the bottom of the candle. Oh, okay. So is it rejecting again? I don't know. Let's go to the next chart. Let's go to the next candle and see what happens. Oh, it looks like it's moving down. I'm like panicking because I think it looks bearish. So I'd be like, hey, maybe you're tempted to actually sell here. But look, it actually closed above the moving average. So we thought that that was closing below the moving average, but it didn't close below the moving average, okay? It actually closed right above the moving average, okay? So we're waiting here and we're being patient for that candle close before we decide what to do. Because remember I said, you don't want to get tricked. So again, we have a close below the moving average, and then we move forward on the chart and we can see that, you know, if we're patient, the data might change. And that's really the point here. You are in a dynamic environment. And so what you need to do is be willing to wait for signs of confirmation. So I'm going to move this forward so that we can really see what happens if we actually wait, because it was starting to look bearish, but then now it's just kind of hanging out here. So it actually still looks bullish. It actually looks like the bulls bought here because there's rejection, bulls bought here because there's rejection, bulls bought here because there was rejection. Even though the bears closed this bearish, technically it's black, that would be a bear bar on my chart, it still doesn't look strongly bearish because the bears are not getting any kind of push down with any strength. If we got one of these down here, then it would look bearish, but it doesn't. So let's continue to move this forward and watch. It's just kind of bouncing back and forth, but now we actually have 2 consecutive closes below the moving average. So that's definitely bearish. And then we start to see this and we're like, oh my God, it looks like the market's plunging down. So let's say that you bought, I don't know, here after this really strong bull bar up, and then you were expecting to take profits here, and this whole thing reversed on you. Now you got this. You're panicking, maybe, because you see, oh, the market's plunging down. And then look, it starts to plunge down again, but then it closes up here. And then we think, oh, you know what? Maybe it's actually bullish. And then it plunges down again and you go, no, actually it's bearish. And so you panic out and you sell. And then it does this and it actually closes. Look what just happened. We plunged all the way down and then it closed up. Now it's plunging down again. Oh my God. And it actually closes up. Oh. So if you're not careful, you'll just get completely smacked around by the markets. And then suddenly we get this, okay? So notice what just happened. We avoided getting tricked because we waited for those candle closes. And if this happens, right, this is called a trap. You don't want to get trapped, okay? And you don't want to fall into something like this, thinking that the market's going down. And the point here is just to show that by waiting for confirmation, you can greatly increase your win rate and greatly increase your mental peace. And that's what you need if you're going to trade well. You need to be able to be calm under pressure. So waiting for that candle close will help you avoid selling when the market looks like that. And you could see those candles, guys, right? It really looked like the price was just racing down repeatedly, but it didn't.
So whichever time frame you're looking at, whether it's the 1 hour or the 4 hour or the 1 day or the 1 minute, it really doesn't matter. You just need to always wait for those candle closures to occur. When you get a closure like
I couldn't agree more.
this above or below a swing point, you are ready to go with your trades. But if you get rejections like this one and this one here, then you should just wait out of the market until the market tells you to make a move. Let's take a look at an example of this then. This is a market that we've started to see pushing up in some bullish price action. Okay, we're getting some higher
Shout out to my man, Captain Crunch in the chat. Patience always wins. You get it, my man.
highs and higher lows forming from an internal structure perspective. Now, if we zoom out, we can see that overall, this is a downtrending market, right? So the larger picture is bearish, and then this smaller picture is bullish, where we're currently getting these higher highs and higher lows. Now we can see what we've got here is pretty much a little swing high. So what we could expect to see would be if the market was able to close above this high, that could potentially lead us into some new uptrending moves, right? So from supply and demand perspective, let's say we wanted to look at possibly buying from this area if the market is able to close above the high that it is currently trading at.
Okay, so here was a prior high, and we closed slightly above that prior high.
So if we were to close where we are, we may anticipate that the market could pull back towards demand and then continue buying. This could be the indication that maybe the market is starting to shift, because we'll have seen that this high here is actually now being broken. So that point just there could be seeing a change in the trend, right? We could be starting to see these buyers take control. Now, this is then the point where we want to make sure we are getting closures above this level, right? Above this swing high. If the market is able to close above, that will give us what we need in terms of confirmation to continue trading higher. But if the market fails to close above, then we could instead be potentially about to see continuations lower in this market, because it will show us that the swing high has been rejected. So a rejection would be no closure, and then a confirmation would be closure above. This would leave us with two scenarios. Well, the first scenario would be if we get the rejection, we would start instead looking for a sell. So a rejection would potentially open doors to sells. If the market is able to close and give us the confirmation, that would give us what we need in order to focus on a buy, right? So confirmation above, meaning if we just ended the hour exactly where we are now, that would be confirmation for us to buy this market. If we reject and we close beneath, well, then that would be a rejection. That's not a confirmation. That's not a closure. The closure's failed. And we've actually just seen rejected price action up there, which means instead we could look for a sell. Okay, so let's take a look at how this plays out then. If we allow this candle to close and the next one to open, we see that we've actually closed with a rejection here, right? So we got that rejection scenario that we're talking about. This is the point where the candle closed and a new one opened. The next candle has been slightly bullish so far with some rejections, but nothing is really locked in just yet. We need to see how this market is going to move. Now here we've seen a little push down in the market, so we're starting to see a kind of rejection that we might want to see. And now we've seen a little push under the previous structural low. Now that we've started to see this market closing a little bit lower, we could potentially be opening the doors here to take those shorts that we wanted to see. Now, obviously, we're looking to see if there's going to be significant rejection again, because remember, if we saw significant rejections, we could actually just see the market go and close back above this high and continue, which is why we always want to make sure we're looking at closures. Now,
so just one point here. Here you can see, right, he's pointing out that we went above that prior high, got rejected, and what we were looking for was consecutive closes. He's saying closures above the high, but I would say consecutive closes. We rejected here. The bulls got rejected, and then this candle closed bearish, right? And now we've stayed below this prior high, right? This swing high, we've stayed below it, okay? And now we're just ranging. We're going up and we're going down. And we have a double top actually, right? We have a top here and we have a top here, okay? So we have actually a bunch of tops here, a little micro top, double top, micro double top, okay? So now we have two consecutive candle closes. However, we also have a double bottom, okay? So when you see double tops and double bottoms, that's just a range. And when the price is ranging, meaning just going sideways, it's kind of like we got to wait and see, because it's not really strongly bullish or bearish. And until we get a strong indicator that the market's going to move down, we have to always default to who is in control last. And since this is a bull channel and we've got higher lows and higher highs, then this is going to remain bullish until we get a strong indicator that the bears have taken control.
Because this area failed to close, we can pretty much eliminate that demand zone. And instead, realistically, targets wise, we would be looking at taking this market back down towards some previous swing lows, right? We've seen a failure to trade higher, which means therefore we could potentially see opportunity to trade lower.
And now we have 3 consecutive bear bars. So this is a possible short, okay? However, as I'm pointing out, we have a lot of buying down here. So I would want to wait here for a stronger bearish indicator before entering. Although it is a possible entry, it's just not a very good one as far as I'm concerned.
Okay. So watching this market, we've seen some closures beneath. Just here, we saw a closure under this level initially.
And this is what you see in a trading range, right? This is a trading range. This is a little trading range right here. And so what happens is the price will usually go a few points below it, and then there'll be buyers down here. It's called a support zone. We already talked about that. And then there was strong buying, right? But then look what happened when we got to push up. Then there's strong selling, okay? And that's a trading range. Back and forth, back and forth, back and forth. Two-sided trading.
Initially, we've then seen the market push down. We'd now be looking to see if we can, again, close beneath that level. And as we have here, we would now be looking at opportunities to sell this market if we were able to pull back. So for example,
okay, and then this is actually what I was saying I would want to wait for, which is a strong bearish indication. This is a strong bear bar closing on its low, which is good for the bears.
The setup we could look at would be something like this. We could sell there, we could have stops above the zone, and targets wise, we could trade this down into one of those areas of supply, right? So allowing this.
Okay, and then where he's entering is actually all the way up here, which is an interesting place to put your entry. And if you, so the upside is if you put your limit order here, then you actually get a really good entry price. But the downside is the price might not actually come back to this level. So you might actually miss the trade if that's where you put your entry. So there's pros and cons with every decision. And those are the pros and cons of deciding to enter here.
This market to play out. You see there, we got the pullback, tap into supply. Now the market.
Yeah, see, this is what I'm saying. Like we didn't actually come up here, right? We actually didn't come up here. If you waited for this bear candle close, then the price just went straight down from that point.
Is pushing down.
So the only way to get into this trade would have been to sell down here, sell below that candle, but then you're selling really low. So that's not necessarily a good entry either. However, as I'm saying, pros and cons every step of the way.
Tackling those swing lows. So that's a good thing. That's what we want to see. Now we've seen as well, there has been a closure under this first level. And now that we've approached this second level, what do we get? We got a closure. So let's just zoom in on that real quick. You can see
same thing we were looking for up here, right? We were looking for closes above the prior high. Now we're here at that prior low and we're looking for closes below it. We didn't get the closes above the prior high here, but he's pointing out, look, we actually do have one below the prior low. And I'm arguing in this strategy and, you know, in all price action, I think you want more than one. So I will always be looking for consecutive candle closes. Because remember the example I showed you, right? Remember the example I showed you. Let's just go back to that really quickly. Look, here was a candle close below, okay, a support area. In this case, instead of a prior low, we've got the exponential moving average as our support area, okay? And look, we got a close below it, and then we got another close below it. But then the price pushed all the way down and then got rejected and then reversed back up, okay? So that's why you want to wait for consecutive closes as far as I'm concerned.
Just down here, the level of which we took profits on that first trade, we have a closure. What does this tell us? Well, this tells us we can go lower. If we'd have rejected this level with a wick and pushed back up, that would be grounds to potentially trade it back the other way, right? We would be saying, okay, maybe the market is not ready to close beneath. Maybe we're seeing rejection. So therefore we could potentially see this market return to the highs. But because we've had this closure just here, we could now anticipate that any pullbacks would provide us with pretty much selling opportunities once again. Now for this, what I'm going to do is drop down to a 30-minute time frame, see if we have any refined areas which are unretested. We've got this supply at the top. Now, if you want to watch a video on supply and demand, click the card at the top of the video just now. I'll also put a link in the description. But at this point, we have supply zone, which could potentially be traded into. We have closures telling us this market is going lower. The reason I would use this,
not telling us the market's going lower, telling us the price is potentially going lower. lower.
But entry is due to something called imbalance. Again, there will be a lesson in the description. And because we have the closures, we're now looking for continued downside. So if the market's able to pull back, we could look for a sell. This sell could continue down. For this trade, let's just keep it simple and look at this open demand zone below. So
shout out to
our
India,
trade would look something
in the chat.
a little bit like this. That would be the position that we could look to take. And that would provide us with opportunity to trade this market lower now that we've had closures. So let's see how this goes. If we run it through, we got closure, second closure, which is good. We have a wick here, but the market did already close beneath. So that is a good sign. It's pretty much what we want to see to confirm the downside. If we have closure, closure, then wick, don't worry about that wick too much because the closures have already happened, right? Then we traded back to supply. We hit the supply zone. We got triggered into the position at this point here. As of right now, the trade is still going. We haven't swept this high, which is where our stop loss would.
Okay, so notice we came all the way back up here and we came up to these prior highs, which were the former resistance area. And look, every time we came up here, the bulls got rejected. Came up again, 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 bulls got rejected. Okay, so if you get 1, 2, 3, 4, rejections over and over and over and over again. That's showing you that the bears are not going to let the price go past that point. So you've got so many confirmations here once the price has done all of this, because you've got 1, 2, double top here. You've got a double top here. You've got another double top here. You've got so many double tops here. You got double tops on double tops, man. It's like a double top explosion, right? So this makes it so that now the price has basically been established that it's not going to go higher than that, but that's still not enough, right? So once you get this, once you get consecutive candles, right? So now we're looking for signs of momentum, because once we've seen that we can't get multiple consecutive closes above a certain resistance area, then we want to look for confirmation again to the downside, okay? And confirmation to the downside can come in the form of strong looking bear bars closing on or near their lows. So we got one here, right? This candle closed below, 1, 2, 3, 4 candles, okay? Maybe more. And then we got another one closing below a bunch of candles. So now we have strong momentum to the downside. And then we got another bear bar closing below. And now we have 3 bear bars closing below many prior bars to the left. So here we now have the market definitely pointing bearish. So you take that, you combine that with the double tops, the many double tops here, and you have 2 data points you can combine together for a reasonable entry.
B. And then you can see that the market has made a big drive to the downside to fill that target, continuing the downside price action as confirmed by the candle closures we got here. We had the closures initially under this level, opening the doors to shorts. Then we had the closures underneath this level, opening the doors to continued shorts once the market pulled back. I want to bring attention, however, to this area here, because here on the 30-minute, we can see the market did actually close, right? This level here was closed above on the
Yeah, so what about that?
30-minute. So although the hourly rejected, couldn't we get tricked into the market from here? Well, what I want to talk about is time frame relevance. Now,
yes, and what I'm going to say about that is that you have to take the context into consideration. So if we go back to the beginning where he said, okay, this is a very simple rule. If we get a closure above that prior high, then that's going to give us a possible long. If we get a closure below it, like down here, then that's going to give us a possible short. You actually are missing one important detail, which is context. Because if you're only looking at a handful of candles like this, you're not seeing the price action to the left. And you have to consider the price action to the left as well. Now in trading, and on YouTube especially, they talk about what to do. But a lot of times people don't explain why. And the problem with that is if you don't know why you should do something, you're not going to have the confidence that you need in order to do it with the kind of conviction that you need in order to trade well. Actual trade with that technique. I'm going to take 3 of my mentors, Al Brooks, Jared Tendler, and Mark Douglas, and say why I think they would agree that waiting for the candle close is a good idea. So let's start with the technical price action rules. Again, we're talking about why. So for technical reasons, if we're talking about just the technical charts, why would it be important to wait for a candle close? Now, here's reason number 1. Avoid false breakouts, okay? we showed you that example, right? Let's go back to my chart. That was a false breakout or a failed breakout, okay? Because the price looked like it was going to break out going down here. And if you remember, we were looking at this and it was looking very bearish because look, we had 2 consecutive candle closes below the moving average. We had this one, but we avoided that false breakout or the failed breakout because we waited for more confirmation, okay? So that's reason number 1. Now, another reason, stronger signal clarity. This is what he's talking about. My man GFX is talking about this. He's saying a completed bar gives a clear view of the price action and it confirms the momentum. So that's a good reason as well. Another reason, number 3, it reduces whipsaw entries. Markets often test breakout points. Waiting for a close helps prevent premature entry. So we've been talking about that all morning. You don't want a premature entry. You need to wait for the data to confirm what you think is going to happen. Better risk management. Rule number 4, the final candle close aids in stop loss placement. Okay. That enhances your risk to reward ratio. Now, it doesn't always make it better, but it makes your probability better, which is good. And then the last one, it confirms institutional commitment. Now, this is to me the most important one, because if you're doing the opposite of what smart money's doing, if you're doing the opposite of what the billionaire whale institutions are doing, like the banks and the hedge funds, then you are, in my opinion, being very silly. Because if you're the only one that thinks the price is going down and the institutions don't, and the institutions aren't showing you some data on the chart with a strong close indicating support from those large players, then I think you're making a mistake. Now let's look at some other reasons, which are trading psychological reasons, okay? Trading psychology. And this is what I believe Jared Tendler would say. I would say he would say that it helps reduce emotional bias. I think, my opinion, my take on Jared Tendler. If I try and channel his brain here, I would say he would probably say that it reduces that emotional bias. By waiting for the candle close, you promote objective decision-making, avoiding impulsive reactions. That's a good reason. How about preventing overconfidence in early moves? Now, Jared talks a lot about overconfidence. I've learned a lot from him. And if you're not familiar, this is Jared Tendler, the author of The Mental Game of Trading. I highly recommend that book. Traders are encouraged to be patient instead of jumping in too soon. So we already talked about that. Here's some more support for that. Again, number 3, it avoids tilt from fake setups. Now that's what you could consider a failed or a false breakout. But what happens on your psychology is your psychology starts getting very unstable. And that's what we don't want when we're trading. Now, rule number 4 for trading psychology, if we're talking about waiting for the candle close, is to support a systematic approach, right? Discipline in waiting for a candle close ensures consistency in adhering to your trading plan. And the consistent traders follow their plans consistently. So that's very important, both from a technical standpoint and from a mental game trading psychology standpoint. What else? It helps manage uncertainty. Now, this to me is the best reason of these 5. The markets are filled with uncertainty and our brains hate uncertainty, and it's one of the hardest things in trading. I mean, it's brutal, the amount of uncertainty. You think it's going to go one way, it doesn't, it goes the other way. And then it goes the way you thought after it did this thing that you weren't expecting. It's just absolutely uncertain, and there's just uncertainty at every step of the way. So when you wait for the candle close, and I really do think that this is the best reason for your trading psychology, is it helps manage that uncertainty, which is such a blessing. Accepting that traders don't control the market fosters logical coping with uncertainty. It really helps you stay calm, which is so key. Now, let's talk about what Mark Douglas might say from a trading psychology perspective. And these are my 2 mentors as far as trading psychology is concerned. 1, it enhances probabilistic thinking. Mark Douglas talked a lot about probabilistic thinking. And he might say that waiting for a close encourages operations based on probabilities rather than predictions. Now, this is a very subtle difference, but there's a key distinction between probability and prediction, and you got to know the difference. Rule number 2 from Mark Douglas, I think he might say it reduces fear of missing out. You probably already know that FOMO is like kryptonite for traders. So preventing emotional reactions from fear of missing out on a move by encouraging patient. That's a very good reason for waiting for that candle close. Rule number 3, improves pattern recognition. A full bar provides better context, helping traders see the broader perspective beyond just that one little candle, right? And the video we looked at today from GFX talked a lot about that and showed you a lot of examples that we've shared with you today. The rule number 4 would be it encourages execution discipline. A structured process of waiting and confirming minimizes impulsive decision making. You need to do everything you can to minimize impulsivity. And if you don't do that, your impulses will kill your trading profits. So by helping minimize impulsivity and increasing the likelihood of you executing and discipline, that's a massive plus. And then rule number 5 here, if we're thinking, what would Mark Douglas say as far as waiting for the candle close? Well, it helps align with the market's natural flow. And that's something he talked about. You want to wait for a close because it aligns you with the confirmation on the charts of where the price seems to be moving, and it reflects the market waves rather than the randomness. Now, Al Brooks would say nothing in trading is random because trading is rational, and I agree with that. But from a practical standpoint, it would be humanly impossible to understand every single tick that happens. And if you tried to do that, you'll go insane. So you need to be able to accept that the market's just gonna kind of flow, and there's only certain things that you're going to need to know about. There's only certain things that you're going to need to know how to do. Okay, and that's good news. All right, so if you're curious about my strategy, go to tradesbybren.com/3setups and you can get my 3 favorite trades, including the patterns that I look for, how I set my stop loss to reduce my risk, and also how I know where to take profits so I can get out before it's too late. Hit the link in the description if you want to get that free download where I break it down for you in a downloadable document. And then I also have a free 15-minute training that I include with that, which shows you real examples on the chart, showing you in reality what those patterns look like. And if you're curious about the tools that I use, as I said, I use TradingView. I really do think it's the best. You can check out the link in the description for that as well. I appreciate you watching. Leave a comment, make friends in the comments. It's a lonely game. Trading is a lonely game. Make friends in the comments. Hit the like button if you liked it and subscribe if you want more. I'll see you next time. For years, the so-called gurus have taught that knowing how to read a chart is the key to making money in trading. But what if that's completely wrong? 90% of traders fail. But this guy right here has managed to beat the odds for over 20 years now. And he says that the secret isn't in your strategy, it's how you think. Is he right? Is he wrong? Is this just another trading lie? Today, we're going to break down Tom Hugar's most controversial insights. Let's dive in to the secret mind tricks of a trading legend.
The argument here is that normal thinking doesn't lead to profitable trading. I want to tell you why I believe that. How did I come to have that belief system? Well, it started 21 years ago. I was 3 days into my new job at a brokerage called Financial Spreads. And I was invited to accompany the best clients of the brokerage and the directors out to a day on the race course, on the race horses. The ladies are wearing funny hats and the gentlemen are drinking champagne and smoking cigars. So there I was, and the CEO of the company, he had introduced me as their newest recruit. And then this is the funny bit, at least I think it's funny. He's saying, he knows charts, as if knowing about chart analysis was some kind of novelty back then. But it was, because back then, 21 years ago, the trading platforms had no charts. When I worked at City Index, there were no charts. So there I was on board this executive coach, and I was being introduced as the person who knew about chart analysis. The first person that just sit down in front of me was a gentleman who owned a string of pharmacies up in north of England. And he said to me, could you please analyze this chart here? And I looked at it, or I remember it. And it was a company called Marconi. Now, what's interesting about Marconi was that it had been a bit of a darling in the FTSE 100 index, but it had fallen.
Okay, so what do we see here? We see an uptrend. We see a trend line break. right? Because if you connect the lows and the higher lows, that would make the trend line here. So then we're breaking the trend line here. Then we're coming back up to test the high. We're getting slightly above the prior high. And then we're getting a bear breakout to the downside, showing a double top. See, one top here and one top here. And then we're seeing a strong downtrend with some small pullbacks, tanking this all the way to the bottom.
From grace, from a price of about £12, 1,200 pence, down to, at this point when I spoke to this gentleman, was trading around 300 pence. The story of Marconi, actually, eventually it went bust. It went to zero. Now, but what's interesting here was that this gentleman had bought a little bit when it had retracted off the highs because he was thinking it was getting quite cheap.
Wow.
Then he added to his position down here. And then he added to his position down here, here, and here, and here. Because as he said, this has got to be the cheapest company I've ever come across. Now, at the time, I wasn't able to formulate my opinion as I was later. But essentially, it was the first time I ever came across an individual who was not trading or investing on the merit of what he was seeing in the market, but what he was actually believing. And he had the misguided notion that a stock that had fallen a lot in price was cheap.
Okay, now this is regular thinking, right? Remember his argument. Regular thinking doesn't win in trading. That's his argument. That's what he's going to try and convince us of in this video. And this is regular thinking, right? Because normally when the price goes down, things are on sale and you're like, hey, I got a deal. And he's going to argue that that thinking will be a disaster in trading. So let's keep listening.
But as I said at the time, I wasn't able to verbalize what I know to be true today. It was to be a few years before I got my next lesson about mass psychology. It was the study that I've spoken about many times by now from Rodriguez from FXCM, who together with his staff at FXCM had analyzed 25,000 of their clients' behavior over a 15-month period.
Wow.
Where they executed 43 million trades in FX.
Wow.
Now, what was interesting about it was that the outcome of this actually revealed that their clients were very good at identifying winning, shall we say, trading setups. But the
65% win rate.
problem that they had was that when they won, well, they won decent, but they lost a whole lot more than they won.
Okay, and I'm always talking about this on the channel, right? You want to combine your win rate with your average size of your winner and the average size of your loser. And see what you can notice here. If you can do some quick math, notice that the average winners 42 and the average losers 82. Okay, so the average loser is like twice the size of the average winner. I mean, if you looked at a strategy and 65% of the time you won, you'd think that's good, but this is actually not good at all.
And so even though they had a very high success rate on their profitable trades, overall they were net losers. Now, at that point, I had been exposed to the behavior of the clients of City Index, and I've become acutely aware how frequent it was that people would be betting against the trend on any given day. So, for example, if the Dow was marching up the page, clients would like to sell short. And if it was falling, you could be absolutely certain that they would want to try and buy the Dow. And sort of armed with that knowledge, I began a journey of, shall we say, self-discovery. I also became much more mindful of what it was that the brokers all over the world were doing to their clients.
So the question to ask yourself is, what is the size of your average winner? And what is the size of your average loser? And if the size of your average loser is bigger than the size of your average winner, you likely have a problem with your trading, and you want to listen very closely to this.
So, for example, any given broker, this is from Pepperstone's web seminar section of their educational on the educational area. When you look at it, it's all about, well, how to read candle charts, how to identify trading opportunities, how to figure out gaps and slippage, and how you can day trade forex. And whilst there's absolutely a place for this, there is a place for, shall we say, learning about the basics of trading. It seems now that we seem to have proverbially put the cart before the horse, and all the focus is now on technical analysis, as if this is going to make us better. So I became much more mindful of that. Even though brokers meant well and educators meant well, all their focus was on the wrong thing. This is not new. I mean, this goes back. This chart here is from 90 years ago, and this is from a course that a gentleman called W.D. Gann sold. And back then, I think it cost the equivalent of the annual salary of a typical worker.
So this is like 100 years ago. Wow.
And there's so many lines and so many dates, and he sold his courses through the narrative of an America that to some extent was religious. He sold his courses on the premise that he had found a code in the Bible. And what's so puzzling is that even now, many, many years later, you still have people who rave on about how great Gann is and how much money they are able or could make from knowing about fractals of 8th and 2/8 and 5/8, and the moon has gone retrograde Mercury and Venus is up Uranus and so forth. And it's actually frightening.
Okay, so this is a chart from 100 years ago. And this is a guy, he's talking about a guy who was selling a course on how to use a secret code that he found from the Bible to trade this chart. And he's showing all these crazy lies. And this guy's just illustrating how ridiculous that is, because there's people that still believe in that BS.
That there are still people able to sell this bullshit, but they are, because it is appealing to a part of our brain that goes, well, if it sounds complicated, it must be worthwhile.
If it sounds complicated, then it must be worthwhile. Now, that's a question to ask yourself. Can you believe in a strategy that is simple? Could it be possible for your brain to entertain the idea that a simple strategy, if applied consistently to the charts, could result in consistent profitability? Or does your brain go, nope, it has to be complicated?
Learning about. Now, when you look at how far
Because this is complicated as hell, right? And this is obviously nonsense. I mean, look at that.
we have come over the last 20 years from when I started trading, it is mind-boggling how much more advantageous it is today compared to, say...
Remember, I told you this guy's been trading for 20 years, okay? So this is his observations after 20 years of trading.
25 years ago. When we day traded the Dow 25 years ago, we were paying an 8-point spread in the Dow. That meant that if you bought the Dow, it had to move 8 points in your favor before you were at break even. So spreads have come down significantly. Knowledge sharing, like what we're doing in Telegram right now, is at an all-time high. It's never been so readily available. Markets are practically trading at your disposal 24 hours a day. You have charts on your mobile phones. Historical backtesting is available to us. And through, we have never been as informed about trading as we are today. Yet when all that is said and done, we're still operating with a failure rate of around 76 to 80%. And as I jokingly said, if that was a dentist school that had a 76% failure rate, you would have to question the teacher's methodologies. Yet, and say this was a school where you're contemplating sending your daughter or your son. 1 second. Okay. And so if this was a school where you're contemplating sending your child, your boy, your girl, and they had a failure rate around in the 70s and 80s, you wouldn't send them there. You go, no, there has to be another way.
Yeah, great. So would you send your kids to a school where they failed 80% of the students? No, hell no, right? That's trading.
And what?
So what does that mean? Does that mean that the way most people are teaching trading is ineffective? Something to consider.
I am proposing is, what is the other way? Because if normal thinking and normal behavior doesn't lead to profitable trading, the obvious question begs, what does?
Okay, so that's the question. What kind of thinking does lead to profitable trading?
So I wrote a book, as you know, which isn't a book about technical analysis, but it's all about how we as traders go about trading, which is the wrong way around. So there's a little audience.
By the way, I highly recommend this book. If you haven't read it, get it.
Question time. How important is the right mindset in trading? And this was a question that Steve Ward asked at the symposium early on this year.
Pop quiz. Put it in the chat. Put it in the comments right now. How important do you think the right mindset is in trading? From 0 to 100%, how important do you think it is?
And it was an interesting question because people sort of started to chip up. Well, I think successful trading is 90% strategy and 10% mindset. And other people are saying, well, it's important to have the right strategy, but it's also important to be able to follow the strategy, and that comes down to mindset. So by general consensus, we sort of landed at a 75%. That's how important mindset is. So if mindset is so truly important and we can't actually make our way to profit through the use of techniques alone, then it does beg the question, well, why is everyone focusing on technique? See, most trading techniques will at best have a 65% chance of success. So a little more than a coin flip chance of 50-50. But if
did you know that? Did you know that most trading strategies will have at best a 65% chance of success, which is only slightly more than a coin toss. Think about that.
That's the case. Why do 90% of people lose? 90% of people don't lose on a coin flip game.
Yeah, right. So if 90% of traders lose, you'd have better odds just flipping a coin and then clicking a button randomly. So what is the difference there? What is causing the 90% to lose?
So when you travel the internet and you frequent yourself with bulletin boards and newsletters and the likes, you will be subjected to the how of trading. The how do I use a moving average? How do I use candlesticks? How do I trade the Dow? How do I trade the DAX, the FTSE, and so forth? All the focus is on techniques. It could be product knowledge. It could be knowledge about money management, etc., which all are important things. But there's absolutely no focus on what are you going to do when you're just about to self-sabotage for the umpteenth time. How do I deal with not taking the trades when I fundamentally know I should be taking them? How do I take a loss when I simply can't get myself to do it? How do I execute a trade that I know I really should be executing?
How do you avoid over trading? How do you break yourself away and stop trading when you see yourself over trading? How do you stop revenge trading? How do you take a loss and not let it throw you off your game?
And so what I wanted this web seminar to be about, and the one in London, is why do we focus all our mental energy on strategies and entries, when in reality, you should spend time on analyzing your psychological weaknesses.
Boom. Okay, so that's a mic drop right there. Do you even know your psychological weaknesses? Do you? Do you know the things that hurt you in your trading that have to do with your psychology? Now, I want to offer you an easy way to answer that question, because that's an enormously difficult question to answer, because these are things that are largely unconscious. They're things that you're largely unaware of, because who wants to think about their weaknesses? We don't like to think about that stuff, so we don't. In fact, we avoid thinking about them and repress them so that we're not even aware of them at all most of the time. And an easy shortcut here is to go to something called 16personalities.com, 16personalities.com, and to take that personality test, answer those questions. It'll take you like 3 or 4 minutes, and it'll tell you what your weaknesses are. And then if you really want to get crazy with it, go into ChatGPT, say my personality type is, and then enter those 4 letters, because that's what the test will give you. It'll give you 4 letters. Take those 4 letters, pop them into ChatGPT, and then say, this is my personality type. What are my weaknesses in trading, and how can I work on them?
What's your weak game? So the foundation of successful trading to me is technique. There has to be a foundation of it called technique. But once you master that technique, of course you can improve. But I think it's much more important that you actually begin to learn about your weaknesses, which come down to your behavior.
Okay, so this is interesting because it's saying that your mindset or your behavior, right, is the actual baseline, right? So this is the bottom of the pyramid, and then at the top of the pyramid is the technique. So he's pointing out that technique is like the icing on the cake, but the foundation is your mindset and your behavior that holds up your technique. Think about that.
And your process. So I argue that getting to know yourself makes you a better trader. It makes you a better person, but it also makes you a better trader. And I'll give you an example of this. So here's the FTSE, and we are seeing a market rallying, but right down here, where the laser pointer is right now, we're witnessing the market has made a low below the highest bar of the day.
Okay, so highest bar of the day is here, and the price has gone down here. We've got 2 consecutive bear bars. The second one closing below both this candle and this candle.
So the highest bar of the day is this bar that we're seeing here. And we have now closed below the low of the highest bar. And especially when this is in the context of a double top, this is a reliable sell signal. So I'm selling short right here in the FTSE. And, you know, it is what it is. Maybe it'll go well, maybe it won't. And then what happens is that the market then makes a push above, at which point I'm going, oh, this is not looking good. But then it comes all the way back down again, at which point I'm thinking, it's all good. It's going to go back down to the lows again. But then what happens over the subsequent bars, actually, let me just pause for a second because I think this is important. So what you're seeing here is Rafa Nadal and Roger Federer headed out to center court for one of their epic battles. It could have been the one in 2007, could have been the one in 2008. But it's not actually those two I want you to look at. What I want you to look at is this. See, this is a quote from an author called Rudy Kipling, and the poem is called If. If you can meet with triumph and disaster and treat those two impostors just the same, then you shall be a success, if you can do that. He wrote it to his son or sons. And what I took away from that is what he was trying to tell his sons is, you know, go through life with a degree of humility. Don't be too excited when you win, and don't get too despondent when you lose.
I love that. It's saying it's saying that winning and losing are both imposters. That's so good.
Because those are just emotions, and those emotions are just like a candle in the wind. It's not sustainable. But what is sustainable is how you go about your daily life and your process. And so the imposter of success, or triumph as he calls it, disaster, well, they're just emotions, but they will detract you from the real journey, which is the journey of being able to follow a process. So
following a process. Okay, this is going to be a key theme here in this video as we move forward. That's worth writing down. The key is following a process, or learning how to follow a process.
When we move on to this, and we see here that the FTSE over the ensuing 2 bars are making a high above that candle, which we saw here. I am beginning to think I'm not in the right position now.
Okay, so he got short here, and he's saying the market pretty much went against him almost immediately, right? If he got short here, that means there was one little teeny tiny doji that went in his favor, and then he got 1, 2, 3, 4 candles in the opposite direction, and arguably his stop is probably up here somewhere. So he's now questioning his position. Yeah, right, because his stop was probably here, right?
Yeah, above the higher of the day. Okay, tough luck, another trade, but that's not quite how I see it. The way I see it is, What can I learn from this? Is there a lesson that I have missed here?
Okay, boom. This is the difference between the amateurs and the professionals. When the amateurs lose, they get really upset and they try and forget about it. When the professionals win, they ponder and they look for the lesson. Which one are you?
Should I have done something different? So when I highlight what's going over here, up here, what I pay close attention to is this candle here. This long candle here, because the market had closed below the low of the highest bar, which to me was a sell signal. Then we get a push higher, which goes all the way back down here. And in my book, this market should have continued lower, but it didn't. Instead, it rallied. And I began to go through the days and the weeks and the months and the years before that, going, hey, is this something that happens frequently? Because if it is, I want to know about it. This is something that I want to learn from. You know, learning from failure is something that very few people engage in. But my role model is a gentleman called Kobe Bryant. I am in awe of Kobe, and rest in peace. When Kobe Bryant died earlier,
Legend.
He was the attention of many journalists all over the world. And they were talking about how an amazing basketball player he was for the Lakers. They were talking about all the records that he broke, how many times he made the NBA, etc., etc. But it took a journalist from the Guardian newspaper called Andy Bull, and he was talking about a different vantage. He was addressing Kobe Bryant from a different vantage point. He was addressing it from his failure rate. See, it turned out that Kobe Bryant, he racked up 14,481 missed shots during his career. Well over more than 1,000 than the second player on the list.
Wow.
And so...
Okay, so just think about that for a second. Kobe Bryant, right? One of the greatest NBA players in history, one of the greatest athletes of all time, had well over 1,000 more missed shots than this number 2 player on the list. That's incredible.
The journalist concluded that actually Bryant's success story began with working to conquer the fear of failure.
Wow, very interesting.
You see, on this previous trade that I just executed, it was so easy to just dismiss it as, oh, well, nothing to learn. It was just another losing trade.
Okay, so I want to ask you guys again. Put this in the comments right now. Which one are you? Are you the person that went and be honest with me so that you can be honest with yourself? Because this question isn't for me. This question is for you. Tell me right now in the comments, are you the kind of person that when you lose, you look for the lesson or you try and forget about it?
Differently. And I believe that that's a mindset thing, that much of our progress as a species and as individuals comes from our setbacks, that we learn from our setbacks. Therefore, our relationship with setbacks is highly correlated with our position in the food chain, both in society and within the hierarchy of our work, within the hierarchy of employment, maybe on our social status. Do we treat setbacks as just that, a step back with no lesson? Or do we learn what is needed to be learned? If anything, did we appear a little wiser the next time a similar situation appears? So when I look at this setup here, as benign as it may appear to you, it actually turns out that this is something that happened quite frequently. Market closed below prior bar's low, and it looked as if, oh, it's going to fail here, and then it marched higher. Right? I got a market that is close to closing below prior bar's low. It looks as if we're headed lower, and boom, high again. Market makes a retracement of 3 or 4 bars, closes below prior bar's low, and up here it looks as if market is headed back down again because we got a push higher, and then we're closing all the way down, and yet the market somehow managed to find the strength.
And one of the rules that I'm always talking about, compliments of Al Brooks, is if you're going to trade against a strong trend, or really if you're wanting to trade against the trend ever, it's better to wait for 2 things. So use this very simple rule to help avoid losses. Wait for 1, a break of the trend line, and 2, a retest of the high or the low. So in this case, if you're trying to short here, right? So you are thinking this is going down, so you're going to short here after this bear close. instead of shorting here, because this is essentially the trend line. So connect the lows to the next higher low, to the next higher low, to the next higher low. Okay, so we can connect a line right here. So once you get a break of the trend line, so this would be the first break of the trend line because the line would be like right here. So that's the first break. So that's criteria number one. Then criteria number two is a retest of the highs. So now we're coming up to retest this prior high. But look at what happened. As soon as we went up to test this high, boom, the bulls got a huge breakout to the upside. So if you followed that rule, then you would not have lost this trade. And it's a good rule for any time you're thinking of trading against the trend.
So I began to think, no, there's something I need to learn here. And I went through years and years of this particular pattern, just looking for this particular pattern, so that I may be 100% prepared for it the next time it was to happen. And then, I've just used a couple of more examples of this. And then something really interesting happened. I was trading the FTSE in an evening not long ago, here in November. And I executed 2 trades in the FTSE at £300 a point at 7,362. Now, what's interesting about it was that it looked to me as if the market is double top, trending lower, and this is just a retracement. But then what occurred to me was, as I had executed the trade, it occurred to me, hang on, what is this thing that I'm seeing right here? And it turns out that that's the exact same pattern that I had done so much research on, and it had just slipped under the radar. And I saw it, and I go, "Wow, I shouldn't be short here at all. I should be long. This is a mistake to be short here." Had I not done those hundreds of hours of research in this pattern, that lesson may have slipped me. But instead, I took my lost about £4,500, £5,000, and it was in the trade for only 3 minutes or so. And then
okay, so imagine losing 5,000 in 3 minutes. In 3 minutes,
very quickly reversed long. Now I know what you're thinking. You're saying, yeah, anybody can say that. So I'd like to prove it to you. Here's my track record. Here's the trades. Here you see, I'm trading. This is 70.
This is why I like this guy, because he shows his trades. He shows his actual trades, so you know that he's for real.
Buying it, 300, another 300, another 300, another 300, another 200. So I'm about £1,200 a point. Now, not all of the trades are held all the way, but eventually the market did grind up, and the best trades were the one that I executed near the highs of the day. I didn't make back everything that I'd lost, but I made 90% back what I lost. And I came out of that trading session thinking, thank you, Kobe Bryant. Thank you for teaching the lesson of setbacks. Because had I not been inspired by you, and had I not done the work on this particular pattern because I was annoyed that I'd lost back then, I would never have gotten a lesson. And I hadn't gotten a lesson, well, I may have been inclined to hold on to this trade a lot longer than I should, but I didn't.
And that's the key takeaway. Okay, so that's what I'm taking away. You tell me in the comments what you're taking away from this lesson right now, because this is definitely so far the most powerful point of this video. This guy is saying that he got over being annoyed, because who loves losing? No one loves losing, okay? But he got over the annoyance, and he went back and researched years of data, learned something, then get this, still messed it up. He still messed it up, right? He still got short here. But then he goes, oh yeah, this is the pattern that I researched, reversed his position to long, and made up for the loss almost entirely, which is awesome. So I want you to tell me right now in the comments, what are you taking away from this lesson? Because this is a very powerful example of exactly the kind of challenges that you face when you actually start to trade. Now, I'm not talking about thinking about trading or learning about trading on YouTube. I'm talking about actual trading. This is what you're going to be faced with every step of the way, is challenges like this. So tell me in the comments right now, what are you learning from this?
Look, the loss. I moved on, and while this is not entirely a success story in that sense that I made everything back, well, I made most of it back. And that to me seems like a victory, and also an enforcement, a reinforcement of the right kind of behavior. So the solution, as I call it, part one, is review and discover. Review your old trades, because in there lies an acre of diamonds, invaluable lessons for you to learn from. But it leads me something different. It leads me something to the next point, and that is it even possible to practice trading?
Great question.
What I call deliberate practice. And it turns out that I have found a way, and I'd like to discuss that with you. The person you're seeing over here to the left, lady, could you shut the fuck up? Some of us are trying to work, or you're yip-yapping away. Be respectful. This person that you're seeing here is a gentleman called Malcolm Gladwell. He wrote a book called Outlier. Yeah, fuck off. He wrote a book called Outlier. And Outlier...
Great book. If you haven't read it, highly recommended. The book called Outliers by Malcolm Gladwell. But he's going to reveal a lie about that book here. So listen closely.
Suggested that if we do something for 10,000 hours, we are going to be experts. It's essentially the difference between average performers and high performers is that they have practiced a whole lot longer than the average performers.
Have you guys heard that before? Tell me in the comments right now if you've heard that before. That 10,000 hours of practice is the difference between average performers and high performers.
And I read that and I probably swallowed it hook, line, and sinker. But there was something about it that didn't resonate with me. And I based that on my own driving. I have been driving for, 30 years. And then I was invited on my birthday to a race course where I put myself into one of those performance cars. I think it was a Mercedes-Benz GT S version. And I had a driver who basically said, do this, do that. So I was driving. And I realized that while I think of myself as a pretty good driver as I'm racing down the motorway, the Autobahn, actually, that's not driving. That's just cruising straight ahead. If you want to improve, you really got to give your mind a challenge to solve, because the challenge for a mind is not there if you're just doing what you always do. And it reminds me of, let me just go to this one here. I was watching Wimbledon a while ago, and there was a commentator who was passing comment on one of the tennis players. And he said, practice makes perfect. And then Tim Henman, who's a bit of a legend within the English the English tennis community, he said, no. Practice does not make perfect. Practice makes permanent. What does make perfect is perfect practice, which was something Vince Lombardi was out. And he's an American football coach who gained an incredible notoriety for his performance and what he was able to bring out in his players. So we go back to Malcolm Gladwell, and the gentleman to the right of Malcolm Gladwell is actually the architect of the research. And his name is Anders Ericsson. He's a Swedish researcher who works at an American university. He was the original proponent of the 10,000 hour rule. But as he stated in an interview, look, I never said that if you practice something for 10,000 hours, you become an expert. What you need to do is you need to create what I call deliberate practice. And the way to create deliberate practice, for example, in the context of trading, is that you set yourself a specific challenge, because your brain is a problem-solving mechanism. And if you just say, I'm just going to study charts, you're not going to learn anything.
Another book recommendation here that goes into this in detail is called Talent is Overrated. It's a book called Talent is Overrated, and it goes into incredible detail on what deliberate practice actually is. I highly recommend that if you're invested in becoming wildly successful at trading.
Because your mind is just going to glance over what is always glanced over. But if you say to yourself, I am going to find out all the single times that the FTSE makes that pattern that I just showed you. And then I'm going to document it, I'm catalog it, and then the next time I see it, I'm going to trade it. And so what Anders Ericsson basically said was that the people that he had researched, the violinists, the pianists, the athletes, they only become experts because their coaches had set them specific challenging tasks that they had to solve. So it wasn't just a question of doing the same serve over and over. Instead, it was about doing the same serve, trying to land it in a particular challenging part of the chord, for example, or that your fingers had to learn a very specific, deliberate sequence to play the violin. That's how you improve, by actually tasking yourself with a very, very specific sort of behavior in order to uncover a new behavior. And what in turn that does is build neural networks. Now, ladies and gentlemen, now perhaps you understand why I like to get my sleep and why I make sure that I exercise and I eat well, because this kind of behavior takes an inordinate amount of energy. Living consciously takes an inordinate amount of energy. And so what Erickson basically said was, Malcolm Gladwell, you got it wrong. It's not about doing something for 10,000 hours. It's about doing it deliberately and truly, truly challenging yourself. Now, how can we do that as when we don't have coaches? And I remember my ex, who was an exquisite ballerina, she was teaching me about the Swan Lake. And within the Swan Lake, which has been dazzled audiences for decades, she's talking about that there's a sequence called the footé. It's a 32 spins on your foot without putting the other foot down. And it's this constant balancing act without getting dizzy. And she said, look, you don't go in and you start balancing. You don't start balancing for 32 footsteps. You do them one little bit at a time, and you build up a big picture until you can begin to actually do this flat-footed. And then once you've done it flat-footed, then you begin to go up on your toe for 1 or 2, and you go back down again, and then 2, 3, and 4, and so forth. And this particular sequence in the Swan Lake has been the bane of ballerinas for more than a century. And those who have mastered it, they didn't just go in and go, yeah, I'll just keep practicing it. No, they set themselves small, deliberate tasks and then solved one piece of the puzzle at a time. So I have split my training into different categories.
Okay, so here we go. I've split my training into different categories. This is amazing. Specific improvement, technical improvement, physical maintenance, mental improvement, mental maintenance. That's worth screenshotting.
And I must admit, I've also split many other things in my life into different kind of categories. So I'll call the first one specific improvement. And so the specific improvement is, say, I feel that I wasn't good at trading trend dating days. So I found all the trend days I could find that happened on a Friday, for example. And I began to make notes on, well, how am I going to trade these on a Friday? How do you actually trade a strongly trending day, especially when it's a positive day, which seems to be...
I'll tell you how I do it. You buy the low of any bar, really, okay? But especially a bear bar, right? Because usually the price is not going to go below the prior bar. But if you have a bear bar, the price will go below. So if you see a bear bar and you buy below that bear bar, right, then you would have gotten filled here, okay? If you see this bear bar and you put your order below, then you would have gotten filled here right before the price reversed. If you see this bear bar and you put your order down here, you would not have gotten filled, okay? But more often than not, that's going to be a solid strategy only for strongly trending markets.
Be my Achilles. How do you do it? How do you actually go about doing that? Navigating around your fears of being the one that's buying the high tick of the day. And going through these exercises day by day, hundreds of them, I was able to actually come up with strategies that enabled to say, you know what, I am going to do this. And the way I'm going to do it is by, fill in the blanks, because I don't want to deprive you of your own research. Let's take another example. Let's take FOMC trading. Not so long ago, we had the FOMC and I served you an 80-point winner, which took us about a minute and a half, and bang. But what you don't know, that there was hundreds of hours of research gone into that particular sequence of events on that particular day. I had taken every FOMC event that I could.
Hundreds of hours of research. How many hours do you spend backtesting? How many? Is it hundreds of hours? Is it hundreds of hours?
Find over the last 10 years. And I had meticulously gone through every single one of them, finding out how do you successfully trade FOMC. And I came up with a trading pattern that I call the Rule of 4. Again, I'm not going to deprive you of your own research, but the Rule of 4 has been something that you have been subjected to, probably without even knowing it. You just heard me say, we're shorting the DAX here, or we're shorting the Dow here, or whatever it may be. But going through every single one of these FOMCs, I found a way to successfully navigate this particular and oftentimes very difficult market to trade. That was my mind being tasked with a very specific exercise, being how do you trade FOMC? When you look at the school run, same story. How do you trade the DAX successfully in the morning? And whilst not everything that I do is turned into gold, for example, I charted the S&P 500 against the tide in the Hudson River, which turned out to be an absolute dud. It just does go to show that I set my mind a specific task, and then I went about to solve it. Now, what I also need to remind my brain of is don't be complacent, because you know what? You have a tendency to do the wrong thing at the wrong time. So I need to show my mind, my brain, what can go wrong if I don't excel in the right kind of behavior. So what you're seeing me doing here a while ago, 9 years to be exact, I went long the FTSE at 6,064. And then I bought some more at 56. And the market went down, and I bought some more at 35. And I bought again at 25. And then in the end, I closed the whole thing, and I lost 17,000 pounds. Do you think that's good
17,000 pounds lost.
trading? I don't. It's awful trading. And that is the point that I need to remind my brain of periodically. Because you have to be the master of your own kingdom, but you also need to acknowledge that your mind has at its core function to enable you to forget pain.
Okay, so I just want to underline something. One of his strategies, which we can all take something away from, is he has documentation, proof of his bad trades. Okay, this is a very bad trade. He was long here, he added here, he added here, he added here, and he ended up having to close the whole thing right here. That's just such terrible. He's buying as the price is going down, which is literally the opposite of what he needed to do here. And what he's doing is, as a way of training his brain, he's looking at those losses and saying, this could be you. This could be you. Don't get complacent. You could really F this up. That's an incredible technique. Incredible technique. So not only should you try and learn from your losses so that you can trade better in terms of what did I miss when I was reading the chart, but also if you look at your losses, and I do this as well, I have them printed out. And I'm going to take this as a reminder to spend more time reviewing those and say, this could be you, right? Those catastrophic losses. Remind your brain of the consequences that can happen when you don't trade well, when you're not at your best. And remind yourself that you're susceptible to errors. Because if you forget that, disaster is right around the corner.
It, as its core, it wants to protect you against pain. It means that it will protect you against remembering the losses because, hey, that's painful. So I am going to do the exact opposite by saying, fuck you, brain. I need you to remember how badly you can act when you're under stress.
That is so money. This is so gold. This is so gold. Everyone needs to write this down right now.
So don't you ever dare adding to a losing position. But what's the opposite of adding to a losing position? What's the very opposite behavior? It is to add to a winning position. And that's why we're doing it. It is not just that we make more when it's going well. It is also that we are counteracting the very things that our brain has a tendency to do to us.
And if you've read his book, okay, his book, again, is The Best Loser Wins. He shows there's an analysis that he was able to do over millions and millions of trades that showed that one of the key behaviors of losing traders is that they add to losing trades, just like this. And one of the key behaviors of winning traders is they don't add to losing trades. They only add to winning trades.
I don't want that. This is a stupid example. But it goes the same. I bought one of those smartwatches. It only cost me 20 quid because I don't need anything else. But I need to know how quickly can I run 10 kilometers? How quickly can I walk 5 kilometers? Am I improving? And why am I just cruising? So everything in my life that I know of, I'm just trying to improve because that's what I get a buzz out of, ladies and gentlemen. Mental improvement. I call it the Book of Horror. Can you see Jack Nicholson in here? He's like from The Shining. Anyway, my Book of Horror, and I've actually taken this from someone who gave me
the Book of Horror. Okay, so this is the collection of all of your worst trades. It's amazing.
These, it's not my own, not all of them, but it's just this is what I have a tendency to do, and I want to be reminded before the trading day starts not to act in the wrong way. I want to act in the right way. So solution part 2 for me is posing specific questions has enabled me to develop a much sharper edge in my trading because I'm not embracing every single aspect of the game. Not every single aspect of it. What's the point in analyzing the FTSE in trading between 12 o'clock until 3 o'clock if you're only trading in the morning? It has to be specific to your particular circumstances. And furthermore, you also have to acknowledge and embed in your psyche that there is no amount of math, there's no amount of indicators, there's no amount of anything that can get you out of having to experience uncertainty. So if you want to trade consistently without the swings in confidence, then you have to learn to accept and tolerate, and perhaps even learn to celebrate the feeling of uncertainty by doing the very things that you don't like to do. Become mindful of the things that you don't like to do. Just like in an example, imagine you're going to a public toilet and there's 10 urinals. You're most likely going to, if it's all empty, you're probably going to find that you want to gravitate towards peeing at the one that is at the furthest left or the furthest right. So force yourself to pee right in the middle. Yeah, it probably means that someone can stand right next to you. But it is those little things that will enable you to living a life outside of your comfort zone. As it ain't as it sounds, but your behavior, if you become mindful of it, will present so many opportunities for you to learn about what exactly makes you tick and what exactly makes you run away. So the reason why I wrote Best Loser Wins was as much for myself as for anyone else. And the chapters in Best Loser Win reflects that. That charts are only a part of a successful trader's arsenal. And the curse of patterns is not every pattern is 100% successful, because we have a tendency to see what we want to see. And if we don't set our mind-specific exercises from a charting point of view, we'll most likely not improve. We also need to learn to fight our humanness and act on the very things we don't like to act on. And only by being mindful of them and having a process, a review process, will you actually be able to achieve that. And maybe you need to drive yourself into disgust before you actually change your behavior. So back when I was a kiddie or youngling, there was a movie with Emilio Estevez called That Was Then and This Is Now by Hinton. It was a movie adaptation of his novel. So when I look at how I did trade, I traded small, I was scared. I traded DAX without knowing what I was doing. I traded the Dow with no strategy. I won a little very often. And then I lost a lot, once or twice. I suffered from the supermarket mentality. So when the Dow was falling, I would be buying.
Supermarket mentality means when the price is down, when the price is low, you think it's automatically a deal.
And buying and buying. I traded without a real plan. I celebrated wins and I extrapolated how much money I was going to make if I continued making money like this. And I ignored the losing trades.
Okay, now look at this list. Everyone look at this list and you tell me in the chat right now, tell me in the comments right now, which of these are you doing? Be honest with me and be honest with yourself, okay? This is an opportunity to do some work here to improve your trading results. But it can only happen if you have the courage and the willingness to be honest with yourself about things that you can improve. So which of these on this list are you doing now that you want to work on? Which of these, okay? Pick two and post them in the comments right now. Now, I'm going to underline this one, ignoring losing trades as the most important one on this list. But you tell me, which two are you doing that you want to work on?
Well, let's look at how I am today. I trade fucking huge, and that's not my line. That's a broker that called me and he says, if you insist on trading fucking huge size, you can't trade at such tight spreads. So I changed broker, but that's another story. And I'm not scared when I trade big. I've developed index-specific strategies, so I know when I can trade the NASDAQ. I know when I can trade the DAX. I know when I can trade the FTSE. I trade the Dow, and I'm very respectful, like a surfer headed out to a raging ocean, because I know it can give quickly and I know it can take quickly. And I also know I lose often, but my wins are bigger. And I don't have an impressive win-loss ratio. But when I do smell a weak market, I smell blood. And I will add, and I'll add. Or like the NASDAQ trade that we did a few days ago. To me, that had all the hallmarks of all the research I'd done. And I was expecting new highs of the day. And we kept pushing and pushing and pushing. And we turned a losing day into a big winning day. So I trade with a plan specific to the instrument and the time of the day. And when I win, I don't look too deeply into it. But I do look. And when I am losing, I try to figure out, what could I have done differently? Was there something I did wrong here? So what I want to say is that slow progress is better than no progress. Remember that. Stay positive. Don't give up. Because if you really want this, all you have to do is to think differently than to everyone else. You are not the 90%. You're the 10%. Why? Well, because I'm training you. I'm guiding you. And I'm telling you what to do.
Okay, now, amazing video by Trader Tom. I want to give you 5 powerful questions to think about. 5 powerful questions to think about, because this is not just entertainment, okay? If you're here, you know I'm not just about entertaining you. I'm here about training and developing you so that you can expand and that you can see actual real results in your life, okay? But that's up to you. Your results are up to you. So what you do with this is up to you. But here are 5 powerful questions. The first one is, are you trading what you see, or are you trading what you believe? Most traders fight the trend. Now, you saw a very powerful example here of him fighting the trend, going against the trend, and it costing him horribly, okay? So Are you forcing yourself on the market, or are you seeing the market clearly and objectively? All right. That's question number one. Are you trading what you see or what you believe? Question number two. If strategies work 60% of the time, okay? If the best trading strategy works approximately 60% of the time, why do 90% of traders still fail? Huh? It's really not about the right strategy, is it? It's about psychology and discipline. These are the keys, okay? These are the keys. Number three, is your trading education setting you up to fail? Is your trading education setting you up to fail? In other words, are you leaving out the most important thing, which is how you think and how you feel and strategies for managing that? Question number four, do you actually review your losing trades or just try and forget about them? And as I said, I think that's the most important one. Learning from failure is what separates the great traders from the amateurs. Which one do you want to be? And question number five, are you practicing deliberately or just repeating bad habits? Remember, the 10,000 hour rule is not enough. You can do the wrong thing and practice that for 10,000 hours and still suck. You have to actively challenge your weaknesses. In other words, are you working on your weaknesses? If you want more details on my strategy, I have a document where I show you my 3 favorite trades, which includes the pattern I look for, how I set my profit targets, and also how I limit my risk and set my stop loss. And if you want to get that download, go to the link in the description. It's tradesbybren.com/3setups. Like the video. If you like this one, hit subscribe if you want more, and I'll see you in the next one. Thank you so much for watching. I appreciate you. This video right here promises to teach you 20 strategies for trading in just 12 minutes. But can anyone actually do that? And also, is trading just about learning every single strategy, or is it actually about knowing which ones work and when to use them? So we're going to watch this video, see what it has to offer, see what's missing, and see if anything in it could actually hurt your trading. Let's have a look.
Fibonacci retracements. It is a tool that displays horizontal lines based on the Fibonacci numbers. These lines can then be used as key support and resistance levels.
Now, if you're not familiar with Fibonacci, something called the golden ratio, it's actually fascinating, and it's something that you see in nature all over the place. So this is the golden rule, or the Fibonacci number, applied to trading, which is just a multiple that you are sort of turning into this repeating pattern.
To use the Fibonacci retracement tool, you first start by identifying a swing low and a swing high on a chart. Then drag the tool from the swing low to the swing high. Next. Okay, and if you're in TradingView, I just want to show people how to do this. It's this tool right here. It's called Fib Retracement. So you can locate that in TradingView by just clicking the Fib Retracement tool, finding that, and then you can actually change the settings to however many sort of levels that you want to see. Wait for the price to make a pullback to one of these levels, ideally the 0.382 Fibonacci level, because that's the most common level where price tends to reverse from. So
what we have here is a bull breakout, right? This is a bull trend, and he's using this strategy to figure out where to enter. And the idea is that the price will retrace right around here, and you can get in at a much lower price than actually buying up here.
If price touches that level, that could be a good buy entry. Keep in mind that price could also reverse from other Fibonacci levels.
That's also about a 50% pullback, right? Probably not exactly, but if you were to measure from here to here, right here is almost a 50% pullback, okay? So you can actually just do that just by measuring 50%. And I'll show you how to do that in TradingView. If you take your chart in TradingView and you just use the measuring tool, and like, let's say we wanted to measure this guy right here, right? Like, look at a measure from the bottom all the way to the top, and look, the price, this is the midline. Okay, so this will show you where 50% is, and look, we retraced almost perfectly to that 50% level. Okay, so 50%, I just want to add in here, also works, and these Fibonacci numbers are just multiples. Okay, so you don't have to get too crazy with it. What I want you to do as we continue to move through these strategies is see if you can understand the simple idea behind the strategy, because it's really ridiculous to think that you need to understand 20 different strategies. But here's the thing. If you understand price action, then you can understand the basis the gist of every strategy. So challenge yourself as you watch this video to see if you can understand what's going on behind the strategy that's actually making it work, because that'll actually improve your trading knowledge regardless of what strategy you use.
Combine it with other confirmation signals to get a better entry. Breakout patterns.
Okay, so we went to Fibonacci. Let's go to breakouts. These are one of my favorites because they're one of the most reliable patterns there is.
It is when price makes a sudden and significant movement towards one direction. This usually forms after the market makes a consolidation period. For example, here we can see that the price is consolidating. Then, it suddenly moves sharply to the downside. This is called a breakout.
All right, now why? Because we broke out below those prior lows.
To take advantage of this, traders could use specific patterns as a guide to identify breakouts before they happen. Most notable breakout patterns includes wedges, triangles, and the rectangle pattern. Reversal patterns.
Okay, so let's go to reversals.
It is when price moves in the opposite direction of the current trend and forms a counter trend. Specific patterns could be identified in a chart which could help traders predict reversals before they happen. Most notable reversal patterns are double top and bottoms, triple top and bottoms, head and shoulders, cups and handles.
Now, these are the highest probability setups. Of all the setups, of all the patterns, setup is a pattern, this is the highest probability in all of trading. Why? Because this is essentially a pullback. So a pullback is once the price has moved in a certain direction, it pauses, reverses slightly in the other direction, and then reverses back in that direction, which is what you see here, right? We broke out and then we pulled back, and now we're breaking out again to the upside, okay? So this right here would be where the pullback starts. Or let's look here. Price broke out here, pulled back slightly, and then broke out again, okay? And let's take the opposite, right? A short breaks out to the downside, pulls back, and then goes back down further in that direction, okay? So one of the highest probability setups, one of my favorite setups, and pullback setups can have, not always, but can have up to a 90% likelihood of going in your direction, which is extraordinary.
Elliott wave. It is a theory that suggests that market tends to move in a series of 5 waves before reversing and forming another set of waves in the opposite direction.
Okay, so I just want to point out something that I mentioned earlier in this video. Remember, my challenge to you as you watch this video is, can you see the strategy behind the strategy, okay? Can you get the idea that's making this strategy work? And I want you to start to see the connections between all of these 20. Now, we're going to cover 20 in 12 minutes as a tall order, but he's going to do it, okay? So look at this and look at what happened here. Now, if the price moved down here, okay, then what do you see here? You see a top, and you see another top. So that's a triple top or a wedge. Now let's go back to the prior pattern and let's look and see, oh, look, that's a triple top. Okay, so this is actually the same pattern, but it's just being understood differently, okay? Because he's taking, in the Elliott wave, you can see that they're counting all of these different moves. So it's not just taking this into consideration, but it's taking these into consideration as well. But the top is a top is a top. It's the same idea. So that's the strategy behind the strategy. See if you can start to find these for yourself as we move forward. And if you have questions, pop them in the chat.
Before reversing and forming another set of waves in the opposite direction. By understanding the Elliott wave sequence, traders can predict where the price is heading by following the pattern.
Which, again, reversal strategy, right?
In a chart, we can label each point of the waves as 1, 2, 3, 4, 5, and ABC. Now, there are specific rules to ensure that a movement is considered as a valid Elliott wave. First, wave 2 cannot be longer than wave 1, and usually pulls back to the 0.618 Fibonacci.
Again, look, we're using Fibonacci again, just like I said, okay? So all these different strategies are going to connect. So I want you to start looking for these connections. And also, again, notice 0.6 is about 0.5, right? It's pretty close to 0.5. And this actually, if 0.6 is here and it went down here, it probably went to about a 50% pullback. So same kind of thing. You start seeing the patterns, start looking for the patterns inside the patterns here, looking for the strategy behind the strategy.
Level. Second, wave 3 must be the longest wave amongst wave 1, 3, and 5. Third, wave 4 must remain above the peak of wave 1.
Okay, now why would that be the case? Why would this have to be above here? Because now that's a gap. Do you see this is an open gap? ICT traders, You might call that a fair value gap, but it's just a gap, right? There's a gap between this high and this low. And what does that show you? It shows you that the sellers tried to push the price down here, but there were so many buyers that they were defended this area, and they told the bulls here, started buying, and they rejected the bears and said, nope, get the hell out of here. This is bull territory. And they sent the price up. And what that did is it left a gap. And what that shows you is conviction on the part of the buyers or the bulls here. Okay. So that's a key indicator because it means that the price is significantly moving in a direction, which is what you want to look for.
Usually pulls back to the 0.382 Fibonacci level. So here's an example of the Elliott wave in action. In this chart, we can see that the price resembles a possible 1, 2, 3 Elliott wave. And so, based on...
And again, breakout, pullback, continuation, just like we've been saying.
The theory of wave 4, which is that price tends to pull back to the 0.382 Fibonacci level before continuing upwards, we can use this as a potential buy entry when price makes a pullback. Fair value gaps. A fair value gap occurs when a candle forms a significant gap due to an imbalance of buying or selling.
Okay, so there's a gap between this high and this low. There's also a gap between this high and this low, right? So depending on your strategy, there's different ways of drawing these.
To find a fair value gap, you first need to find a candle with a large body. Then, draw a rectangle at the gap. Place it between the previous candle's wick and the next candle's wick.
Right. You could also draw it here, right? And notice that we actually tested this high, this prior high, instead of this prior high.
This level now acts as a potential magnet, where price may revisit before continuing its movement.
Right, so if we wanted to draw this gap before this candle formed, right, then we could say, okay, let's actually watch where this big bull bar broke out of. And notice, it broke out of all these highs, and this was the most recent one that we can see. That's the highest one, okay? So it broke out, closed above this one, and then we could say, oh, look, right here is where it's going to come back and test. So then this candle went back and tested exactly that point. Do you see that? Look at the line. See that? Okay, so that's a really interesting observation. And when you use this understanding, it can help you get entries that are absolutely spot on. So let's see what else there is to learn about fair value gaps here.
Candlestick patterns.
Okay, so that was it. So this is a 12-minute video. We're not going to get a lot of detail.
It is a technique that traders use to analyze future price movements by looking at specific candlestick shapes. Notable candlestick patterns include engulfing patterns, which signal strong momentum towards the direction of the engulfing candle.
Okay, he's calling this an engulfing pattern, right? Why? Why is this an engulfing pattern? Because it's, it's bigger and engulfing the one prior. You see that?
Candle, hammer and shooting star patterns, which indicates rejection.
I would just call this a doji, but yeah, we can get fancy with it too.
As shown by the long wick on one side. Doji patterns, which signals neutrality in the market. Heikanashi. It is an indicator that fully replaces a traditional candlestick chart to a Heikanashi chart. When applied, it tends to give less noise than a traditional candlestick. A green Heikanashi candle signals that the price is on an uptrend, and a red Heikanashi candle signals that the price is on a downtrend. The size of the candle's body also indicates how strong a trend is. The larger the candle, the stronger the trend. Keep in mind that the Heikanashi only acts as an indicator. It does not display the real market price. Moon phases.
Moon phases.
It is a concept that utilizes moon cycles to time the market.
This is not a joke, people. This is not a joke.
Moon phase traders believe that moon cycles are correlated with human emotions and behavior, which could have an influence on the market.
What's kind of fascinating is, like, you can see it actually kind of works, okay? It actually kind of works, which is kind of cool.
With human emotions and behavior, which could have an influence on the market. Specific moon phases are believed to be favorable towards a certain trend. A new moon means the market tends to be bullish, and a full moon means the market tends to be bearish. Today, it is used mostly as a confirmation tool. Renko.
Okay.
It replaces a traditional candlestick.
I should change the name of the channel to Full Moon Day Trader. And that's all I'm going to do from now on.
Chart to a Renko chart. So, unlike a traditional candlestick which forms a new candle based on a certain period of time, a Renko chart forms its block based on the change of price. For example, every 1% change in price, a Renko block appears. This means that each Renko block represents a 1% change in price. Of course, you can change the parameters of this through the indicator settings. Traders could utilize Renko charts to filter out noise and identify trends.
Okay, I just want to say, there's no such thing as noise in trading. You know, I'm a student of Al Brooks and I learned this from him. There's no noise. If you really think about it, there's no reason why anyone would ever execute a trade for no reason. There's one reason why anyone ever executes a trade. It's to make money. And there's a reason why they're executing that trade, whether that reason is valid or not. So all trading is logical and rational for that very reason, which means there's no such thing as noise. So the problem with saying something is noise is really, you're just actually acknowledging there's something you don't understand. So see if you can not say that, right? See if you can not say something is noise, because if you say it's noise, you're just actually pretending that there's nothing there that's rational or logical, but it's not true. So that's something you want to listen for. And also, if you think something is noise, like it's just random, actually study it so you can learn and understand the logic behind what's actually happening. That's a much better attitude than, oh, filter out the noise.
A green Renko block signals an uptrend, and a red Renko block signals a downtrend. And keep in mind that Renko charts only acts as an indicator. It does not display the real market price. Harmonic patterns. These are advanced price patterns that follows a specific shape based on Fibonacci numbers. Traders can then use these specific shapes to predict future price movements.
Again, so harmonic patterns, going back to strategy number one, Fibonacci, it's using Fibonacci numbers to come up with a pattern of how those numbers show up, okay?
For example, a bullish bat pattern is formed when price makes a series of 4 movements that is shaped like the letter M. Each point can be labeled as X, A, B, C, and D, and each of these points has a specific guideline. For example, point X to point B needs to have a value between 0.382 and 0.5. Point A to C needs to have a value between 0.382 and 0.886. And the same thing works for the other points. Next, these specific guidelines can then be applied onto a real chart. So, if you see a price forming a series of 4 movements, you can apply the harmonic pattern tool to check if the price that formed matches a pattern's guideline. If it does, then you can take a position based on the pattern that formed. There are multiple harmonic patterns that exist. Most notable are butterfly, bat, crab, and each have their own unique values.
Okay, this is where we get into some pretty ridiculous SHIT, okay? So yes, you can come up with all kinds of fun little animals if you want. If you really want to have fun with it, I got no problem with it, having fun with it. But here's the problem I have with the strategy like this. You're insisting that the market fits these very, very rigid criteria. And you're not going to take a trade with this according to these rules unless it fits this very, very rigid criteria. Now, as I said, there's nothing wrong with that. However, if you don't understand what's happening here, like, you're gonna be at a major loss, okay? Because what's happening here is a double top, right? Remember we showed you triple tops earlier? Right? Remember that? We were looking at breakouts, and then we went to reversal patterns, and we showed you this triple top or a wedge, okay? So these are basically 2 double tops within each other, okay? And then you got double bottoms here or a triple bottom, okay? You can see it different ways, but you've got a bottom and you've got a top, okay? So if you don't understand this first, then you're going to be very confused when you start trying to understand something like a harmonic pattern. And what I'm arguing here is that you want to focus on what's the actual strategy behind the strategy, okay? And the strategy behind the strategy, in the case of a harmonic pattern, well, let's see what we can learn. We've got a top here. Okay, so we've got a top here and then we've got a bottom here. You see that? So look at the tops and the bottoms and look at learning how to identify tops and bottoms. And once you understand that, then you can start to understand all patterns.
And 0.886. And the same thing works for the other points. Next, these specific guidelines can then be applied onto a real chart. So, if you see a price forming a series of 4 movements, you can apply the harmonic pattern tool to check if the price that formed matches a pattern's guideline.
And remember, he took a buy order down here, right? He took a long position down here. Now, if I look at this and I'm just trying to understand this in very simple terms, I would say, well, look, this is a trading range because we went up and then we retraced almost the entire move. And in a trading range, look at what buyers and sellers are doing. They're buying at the bottom and they're selling near the top. So if I see this pattern, I'm going to be considering getting long down here because there was buying and there was a bottom, right? So I see a bottom here and a bottom here, and I go, man, it looks like we are trying to make another bottom here, and I'll look for an indicator that the price is indeed reversing there and consider getting long. That's one way to look at it as well. So see if you can understand the strategy behind the strategy here.
Then you can take a position based on the pattern that formed. There are multiple harmonic patterns that exist. Most notable are butterfly, bat, crab, and each have their own unique values. Support and resistance. These are key
Okay, now this is one of my favorites here.
levels that formed horizontally where the price has bounced off in the past and could possibly bounce again in the future.
The reason why I like this strategy is because it's very easy for a beginner to be able to identify these things. And when I was first starting out, this is one of the things that I started to be able to identify right away. So you can see, look, you could just draw a line there because the lows are all bouncing up and reversing around the same area, right? Same here, right? I was just looking at this earlier before starting this video, right? Look, you've got a top here. So you could identify that area and then look at where I drew this area here. See, the price was moving up like this. And I noticed that there was an area of support here. Support and resistance are magnets. So I'm like, the price is getting sucked up to this area. And then look what happened. The price now is getting sucked up to this area. So we can draw another resistance area in this case, and we'll make it green we'll make it, we'll make it red for resistance, okay? Because there'll likely be sellers up here. So if you're a beginner and you're just starting out, okay, can you just look and say, okay, look, there looks like there's a top there. And if you move to the left, oh, there's a top here too. So if you start to see one top, two tops, three tops, then you can start to learn very simply how to identify these resistance areas, whether it's at the top of the chart or it's near the bottom of the chart, okay? So if you're new, start to look for support and resistance areas because that's one of the best ways to start to train your brain how to identify these patterns in real time.
If the level is below the price, it's called support, where you can take a buy position if the price approaches it. And if the level is above the price, it's called resistance, where you can take a sell position if the price approaches it. Dynamic support and resistance. Similar to support and resistance, dynamic support and resistance also acts as key levels, but instead of using static horizontal lines, it uses indicators like the moving average to act as our key level. Trend lines.